up without you on this sunny Friday morning with Ronnie Eggnog. Hey!
Hello, Irish. Good morning. Happy to be back.
Happy to be back. Are you still holding on to your summer holiday glow?
Well, it wasn't much of a summer holiday. It was a working holiday. I was working from the Stockholm office past week, yes. So I was mixing
he brought
pleasure and
back
business.
He brought back these sweets,
which no one appreciated. Let
I
the record
appreciate
show.
it.
Yeah.
I appreciate it. I had
But producer Phil and his posse came over after I offered them the Swedish snacks. They came and they just laughed and then they went back.
I ate the marshmallowy
Really
one. The sweets from Sfera. I had the marshmallowy one with coconut. Is that right?
Yeah.
Speaking of coconut, I was looking at your shoes when you came in. I noticed you're wearing Hoka. Is that right?
I am a hardcore Hoka fan.
Wow. Looks like you might have, been one of the reasons why Nike's results were the way they were. We'll get to that in a second, but let's just give you a quick recap on how we are doing right now. We are counting down to the open, and it's looking still like a risk on mood out there. I mean, it's incredible, isn't it? This week has been a complete epitome of how markets have just shrugged off.
Yeah,
uncertainty.
I was listening to Goldman Sachs head of ETFs and baskets this morning, and he described it as sort of walls, which the market loves to climb, and whatever the worry or the concern has been, whether it's been tariffs or DeepSeek or Middle Eastern escalation, the markets just climb these walls and they've gone past it, and now the Nasdaq is at all-time highs and the market is continuing to rally. And I was speaking to my client the other day, and he was just, well, him and I, we were both baffled over the fact that the market was continuing to rally. But it's sort of, one has to ask the question, how long can US exceptionalism continue and what can actually stop it? Because as of right now, it doesn't seem like anything can.
What was your client's view as to why markets continue to scale to new highs? They said it was because, it's just money needing to find a home somewhere, or is it the fact that everyone's anticipating these rate cuts from the Fed?
Well, it's a bit of a mix as well, because if you look at, for example, American sort of allocation, so there's been a lot of allocation away from the US by sort of institutional funds towards more emerging markets. But within America, there's this constant passive buying into ETFs via their 401ks, I think it's called. So it's just a constant, continuous trading of it, and buyers exceeding sellers. So as of right now, there's not really, he's struggling to grab his head around it, and so am I, if I'm being completely honest.
And then, of course, there's the other thing about tariffs now. Suddenly, Safe Arbor, Matt Arbor, now talking about this. Suddenly, it's almost like, these tariffs seem to somehow be forgotten and kicked down the road. We have had July 8th, which is the so-called Liberation Day, trader friends, for tariffs that's set to take effect after that 90-day pause. Now, apparently, it's a gray area. July 9th is the deadline for an EU deal to avoid those 50% tariffs. Not much has been spoken about that as well. And there have been some reports implying that, Trump might perhaps push that down the road as well. So no surprise, given all of this, that stateside S&P 500, as you heard Ron Dog say, rising to within a breath of a new record high. And also markets, stock futures, this is for the US, moved up during Asian hours. So we are looking at, a risk-on session at the moment, at least for the moment right now.
Yeah, Howard Lutnick came out and said they've agreed to a trade deal with China 2 days ago. No details were given.
And China's kept really quiet, right?
Yeah, China hasn't said anything. Lutnick hasn't given any detail, but he has said that they've agreed to a deal, and I think that's the sort of headline risk or sort of volatility mover that we've seen and sort of grown acquainted with during the Trump era. So just come out with a statement, a headline, and then the market rallies on it. So I think we're going to have a strong day for the futures and the US indices today as well.
Yeah, that's right. And Caroline Levitt as well. This is the White House spokesperson. Trader friends, check that out if you haven't already, because Caroline said that the impending state of the tariff deals or the impending start, she downplayed it. She didn't actually say, you know, it's going to start. There was no drum beat to any of these, you know, deadlines being sort of met and kept. So, you know, the mood right now is that the US, at least the White House, is downplaying those impending deadlines. Let's have a look across the space here too. Welcome our trader friends here. Matthew Stevick saying, don't worry about a thing. Tariffs won't be a thing. 80 years old. That's how old Bob Marley would have been this year, I think. I think this year is a big year for Bob Marley. OL102, JG, good shares. I like value preservation. Neil Brewster, good morning to you. And Funky Gibbon as well. Monkey Man, false start. And Jesse 14, guten Morgen. To you, have you received that thing in the mail yet from me? It's smaller than expected because of the mug was way too expensive for the, I think, IG post room. Boston Frank, good morning to you as well. And Poppy says, surely time to sell when all are so bullish. I like that. The contrarian view and everyone is like, you know, talking it up. That perhaps might be time to get out.
That's something to look at. And another thing that the head of ETFs at Goldman Sachs said, that it's easy to look at just the indices, but also it's a stock pickers market as well, and sort of industry pickers market. And one thing that they've looked at and seen a great trade that they've looked at. So they asked them, so what's the trade? And for them, the pair trade is doing sort of long the winners of AI. So whether it be Mag7 or whoever's, whichever other companies are there to benefit from it. But then they also take the opposite side of the sort of biggest losers of AI, because that trend has sort of continued across. We haven't seen any sort of downfall or any sort of slowing down of that spend. I mean, Meta is now investing 50% of buying Scale AI at a $15 billion valuation. So the spending is continuing, the capex is continuing in AI, and I think that's reflective on the markets as well.
Matthew, please let us know if you are watching from New York. If you are, very early morning to you. And please going to get some of those rib tips if you're there. I used to work there. The most common comment when markets cooking with gas, the contrarians, they never do well. You egging Poppy there to sell. Right, shall we go to overnight action, people? Hey, trader friends, welcome back. This is Overnight Action with myself and the Ron Dog, where we take you through some of the news headlines that are tradable that have happened over the overnight, really. How was your evening?
Yesterday.
Yes. Were you like me watching out for Nike to figure out, you know, what's happened with the earnings? We had a huge amount of trader friends asking us about, you know, what the expectation was. And I did wake up momentarily because I fell asleep. Rich is on the beach, people. Who else is on the beach? Everyone's on the beach except for us.
Yeah, we're here maximizing shareholder value.
Adding value to, you know, to IG's, you know, clients, helping you trade better, whilst Phil and Rich are with speedos on, sunglasses.
Yeah, there's word on the street that Rich is adopting the Italian fashion, and he's wearing the thong speedos on the beach.
Or the green one, the
Borat one.
Yeah, the Borat one. The Borat one, the monkey.
Well, I think for all the children present, I hope not.
That includes Monkey Man and very young Gavin Ackers. Gavin, are you there listening? Gavin unveiled his age on the comments page yesterday.
Gavin Akers.
Yeah, Gavin Ackers. Yeah. So just quickly moving my screen across and making that bigger for you. Nike, take a look at that because Nike's shares were very interesting and they rallied in extended trade. Companies saying profit and sales declines would narrow or would start to narrow. And the cost of the tariffs expected $1 billion to approach $1 billion for the company. Now, the interesting thing about this as well is that the shares surged 10%. Perhaps there's faith that Elliott Hill's turnaround plans finally taking hold, do you think?
Yeah, I think it's the sort of big Nike paradox, as Claude put it for me, as I was summarizing my notes this morning. The results in a silo are horrible. I mean, worst quarterly results in over 3 years, revenue down 10%, profit falling much more than that, close to 80%. Yet shares surged 10% after hours. And I think, like you say, it's the turnaround plan that is the key emphasis here. The expectations were lower, but they were beaten. So even though they missed in terms of where they were 3 years ago, they're still beating the expectations of the turnaround plan, showing that they're doing something on the right side here. And I think it's the same thing that we sort of saw with Starbucks earlier throughout the year.
Yeah.
Expectations are low, but the expectations are to see some sort of improvement. And when you see that improvement and more than expected, that's when you see that there's actually a plan forward, and the plan is working in order to get the stock back to where it was and bringing the company back to the center of the consumer's mind. So I think so far they've done a really good sort of actioning of the turnaround plan. I think the outlook, the sort of longer term outlook of Nike is quite interesting, as well as we have the World Cup coming up next year. So for me, Nike, I think it's a good quality stock. On the other side of it, we've had losers such as Lululemon, who haven't been able to capitalize on this. So I'm interested to see how the Adidas stock acts today as a pair trade. But in my mind, I think Nike is doing everything that they need to do, and they're doing a good job. And I'm bullish on them long term. What do you think, Ange?
I'm thinking Rich has been waiting for this,
Yeah, he's
the day for since September, right?
Yeah, pushing 70 now.
Pushing 70 now, and creeping up in the space. And I think that really this is a key sign that investors have confidence in this turnaround plan. Don't forget, as Ron Dog was saying earlier on, just like Starbucks, they kind of lost their way. The brand forgot what it stood for and really failed to emphasize the direct to consumer line there. But it seems to be, with the new structure put in place by Elliott Hill, it looks like they're starting to get to grips with that right now. They've done really interesting things, like they've got Faith Kipyegon in place, who wears Nike branding, sponsored, because Nike wants to really recapture the female consumer and client base, which they have long cast aside, because they just went for this mass market, right? Cheapest one size fits all, pardon the pun, and lost the ground to Hoka, to the Ons, who were coming up with more innovative, more price competitive products.
Yeah, I mean, I think they've learned the hard way that if you try to sell to everyone, eventually you end up selling to no one.
Yeah.
And they also did a big mistake in sort of trashing their retail relationships by going simply online. But Andrew McKelvey in the chat asking, with Adidas and Puma up pre-market, will JD Sports get a lift today? I think it's more than likely that they will, because a strong Nike results and a strong Adidas and Puma sales as well is something that will be directly reflected in the JD Sports sales. So I don't think it's something that will fuel it long term, but it's something that can definitely give it a big sort of lift today in the morning, as traders sort of draw the comparison and the parallel between the two.
Yeah. We have Matthew also chiming in on the chat saying that Bill Ackman, a big shareholder of Nike, also want to point out, that what Ron Dog was saying about Starbucks, also a similar story there. They really lost their way. They forgot what they stood for. The brand of Starbucks, I'm going to show you the shares just to emphasize how much pain Starbucks has gone through because of this misstep. Is the fact that this is the daily chart, people. They went from a cafe atmosphere where everybody wanted to hang out, and they had baristas that basically looked at you in the face, in the eye even. When was the last time a barista looked you in the eye, Ron?
I don't go to Starbucks. I got free coffee in the office.
That's why.
That's the socialist in me.
That's why Ron Dog has the big bucks, and we're all here still slogging away.
Yes, so much big bucks. That's why I'm here 7 in the morning.
But those of you, and Matthew, if you're in the US, you can concur as well. And all of you there that travel to the US, and you've seen it happen here too. No longer do they have people that kind of, never mind writing your name on the label. In the US, I was shocked to find that they just pressed the button. They typed your name in, pressed the button. There was a machine that chucked out the drink at the end. And someone just stuck a label on it and they left it there to cool. They don't even call out your name anymore.
Outrageous.
Outrageous. So now Starbucks, similar to Nike, also staging a turnaround plan, restructuring. Look it up, people. They're now starting to really invest in seats and tables again. And that service, that means eye contact.
Yeah, and something that's quite interesting is that they're looking at partners in China. Because they've lost a lot of market share to who's the big Luckin Coffee? What's the name of the
Luckin. With the deer antler type thing, yeah.
So they've lost a lot of market share towards the sort of big Chinese consumers, and it's obviously a massive market for them. So they're looking now at partnership there in order to have this sort of, which they've had a lot of interest for, they've said. In order to sort of have that cultural and local expertise. So I think that's a smart way to go about it.
And China is a completely different market altogether, right?
Yeah.
So, in China, they just want speed over eye contact. So Luckin's got it completely right there. You can go and buy a Luckin coffee under like seconds once you put it on the app because they're so super quick there. They have
WeChat.
Yeah, WeChat. They have tons of staff there. And then on WeChat itself, because I used to work very closely with a lot of clients and a lot of big banks there and creating content for them. With the Luckin Coffee and WeChat as well, if you bought, let's say Ronnie was going to buy, 6 more of the same coffee for his wonderful friends, Luke, Moore, Minnie Cooper, Wardy, Sean, call out all you guys on the desk. WeChat and Luckin would immediately give you a 20% discount.
Oh, really?
Yeah. It's all about community buying over in China, which is why they have the Pinduoduo and the Dingbao as well, which is different to Europe. So understand your market, people.
That's what I always say, the Dingbao. That's the key.
Matthew is saying, yeah, 100% drifted away from the original brand and service that made it Starbucks, where you wanted to hang out and have coffee and sit in nice comfy chairs. They're bringing that back here too, but very, very slowly. Andrew McKilvey asking about JD Sport. Let's have a look at JD. I was looking at JD.com earlier, but let's have a look at JD Sports because he was asking, is this likely to have a lift on Nike's results?
We addressed it earlier, but I think it's going to have a positive lift for JD Sports.
Yeah.
Longer term as well.
Yeah. JD as well is a good, by the way, a good place to kind of look at how these brands might progress as we move onwards, because I was saying to Aaron and also Matt Arber that a strong indication of whether a brand is doing well or not is whether you see a big pile of knockoffs.
Yeah.
Right, in the JD Sports. Andrew, what I can tell you is that Puma and Adidas are both looking like they are going to rise around 3%. This is the pre-market indication here for you. Andrew McKilvey really likes a heads up. Any upgrades, downgrades, that's his bag. So I hope that helps you here. We're all about not talking about noise, but talking about what helps you in your trading. And Adidas Puma seen topping the blue chip DAX as well.
Yeah. Do we want some upgrades, downgrades?
Yes,
okay.
yes, let's do that.
Indra has cut have upgraded Morgan Stanley to overweight, 47. Then we got double downgrade by, I don't know who these brokers are. Citi and JP Morgan cut to neutral. And then what else do we have? That's about it. It's a very slow morning today. Let me see if we get the Singers pre-market. Maybe you can entertain the people in the meantime.
Yeah, I am getting up my list here as well, and we are seeing across the universe here of Angie's scraping. I've been developing this way of scraping. It takes a bit of programming. Andrew McKilvey knows I've been trying to do this specifically because of him and our other trader friends have asked for this, but we are looking at movers like actionable might move. This is because they have agreed to sell its Indian unit to JSW Paints for more than $1 billion. Also, in terms of elsewhere in the universe, we of Angie's scraping, it's pretty quiet out there. It has to be said today. Do you ever use Buzz, Ronnie?
Buzz Lightyear?
No, as in Buzz stocks. Do you ever use that?
No, please enlighten me.
So there is a function on LSEG workspace called Buzz. But the problem is, and I know this because I used to work for LSEG, they then decided to outsource all of the Buzz writers who I train to India, Bengaluru. And then suddenly Buzz, which is meant to give us the biggest move, it's just one line, this is the biggest movers. Suddenly it all got inundated by Indian stocks. And so I now have to build a scrape to try and get the European stocks out of all these like Indian names. But it is also a quiet day. There are a few. Nor Bremse. This is another one, KNORR. If you haven't heard of this, you can get it on the IG platform. This one expected to move down. This is the early indication in early Frankfurt trade after JP Morgan cut to neutral from overweight. And also we are now still 8 minutes to the bell, looking at potentially a higher open. So for those of you, I know lots of you just trade the DAX, we are counting down to what is expected to be a higher open there. Futures pointing to FTSE up 0.2%, and for the DAX it's 0.2% there. Gold, let's have a look into the commodities space as well. Gold looking like it is down more than 1% at the moment, and many market watchers, many houses out there, this is the hourly chart, so you can see it tracking lower. Many houses out there saying that perhaps this move is going to continue as we count down to the PCE. I think that's around 12:30.
Yes, it sounds about right.
Yeah. So that is what we have at the moment. Taking a look elsewhere on overnight news. We also have all this talk about, the Fed and potentially new Fed governor being named quite soon. You still thinking we might just get 2 expected cuts this year?
From the US, I'm thinking 0.
Ah, interesting.
I think, okay, maybe not 0. I think we'll get 1. But you know what? I'm going to be a bit of a contrarian. I think we're not going to get any this year. I think we're going to see a bit, we're going to see the Fed staying put on where they are. I don't think we've seen enough data to be sort of showing us that we're in the need of a cut. As we said before, I mean, the US exceptionalism has just proven something incredible. When the rates went from 0 basically to 4.5, and we've stayed there for over 4. There's been some, creaks, and there's been some hissing from the machine, but the keg's still been running in the U.S. American economy, the sort of American machine. So I don't think we'll see much sort of convicting data that will get the Fed to cut. Perhaps once Besant is replacing Powell as the Fed chair, we'll see. But I think for now, the US might be a bit of a contrarian and remain put until they feel that they've fully beaten inflation, they've gotten the economic levels down to a rational level.
Cool. Interesting your contrarian view, because I think we have potential for two, at least one, because things could still get worse, and we're expecting I have a 50-50, so 50% of my sources who come from a mix of fund managers, strategists, money managers, they are still looking at a 50-50 chance of hostilities increasing in the Middle East in the coming week. So until I see that sort of go away, then I'll join you on the I would like to join you on the contrarian view.
Realistically speaking, I think there's going to be cuts. I'm just trying to be a bit of a contrarian. I definitely think there's going to be cuts, but if there's no cuts, I wouldn't be very surprised. Just as I wouldn't be surprised if I didn't get told in my ear that I need to tell the viewers at home to like and subscribe.
Yeah. This seems like a poll here, trader friends. Do put it in a chat how many cuts do you expect this year, or if any at all. Please let us know. We are going to go to a short break, and we'll be back with the opening bell. And Andrew, if you look at the chat, I'll try and get you some more of these upgrades and downgrades, because it's starting to come through thick and fast.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
Hey, trader friends, welcome back to Opening Bell with myself and the Ron Dog here. We are less than a minute to the open here. Ronnie, you ready with the bell? 5 seconds to go. 3, 2, 1, and here we go. That's a very strong finger.
Sorry.
Very strong.
No pen today. Budget cuts. But I sacrificed my fingers' well-being for you guys. I hope it's appreciated.
Strong man, this Ronnie here. Just bring up my screen here. We are out of the gate, and as I mentioned earlier, it is a strong risk on open there. Germany 40. Read you the pre-market earlier. It is slightly higher than that, even up 1% now and gaining ground. FTSE also up 0.25%.
Yeah, let's have a look at the UK stocks.
Yeah. See how all that is shaking out. And here we go. And making that slightly bigger for us. Here we are,
look
Ronnie.
at that. JD Sports.
Yeah.
Over 5.5%.
There you go, Andrew McKilvey.
That's your answer.
Always on the money there, Andrew McKilvey. But also, let's have a look elsewhere too in this space. We've got Pearson talked to you about that broker move earlier on. The Rio Tinto and Anglos are also up strongly there.
Yeah, they've been on a tear these past few days. They're continuing the rally. It's always exciting to see because they're such a big part of the FTSE 100. And we often complain that it's too defensive of an index, so it's not moving as much as we'd like to. But it's nice to see that these sort of big juggernauts are doing so. Barclays up there, which is they've had a rough couple of days, but up and down. So I'm happy to see Barclays coming back up. What else do we have? What's popping out at you, Ange?
Antofagasta, the miners having a good one, good session, and no surprise there given we've seen, continued weakness in the dollar.
Yeah.
And if we get these cuts, we have a poll right now, trader friends, so make sure you enter the poll. I have already, as I was getting those upgrades and downgrades and the scrape test that's ongoing here onto the chat. So I hope that helped you, but do put your poll in. Do you think that perhaps you're on Ron Dog's side where there are no cuts, or perhaps one cut or two cuts? Put in your votes, and don't forget to slam the like and subscribe button if you like those early calls, those upgrades and downgrades from myself and Ronnie. We can bring more of those to you. Intercontinental is up 0.2%, and WPP also up slightly there. Lots of nice consumer names. Let's go over to the losers list, shall we, Ronnie?
Yes.
Here we are. Right. We have
no major losers. Nothing that's really popping out at me. BT Group, M&S giving back some of the gains.
You like M&S, don't you?
I do love a bit of M&S. It's out of my budget. Keep in mind, I'm a PAE, not a PCM. Once I become a PCM, I might have the M&S budget.
But you save so much money getting the coffees here.
I do. I save my 2p a day, or £2 a day.
Let's have a look at, the Helion is the company that's been spun off, of course, by Glaxo. And one of the biggest products is Sensodyne, for those of you that trade this space. Marks and Spencer, let's just have a look at the share price because I want to see whether they have recovered somewhat from their cyber attack, because they were one of the ones that were hit.
Yeah, when was the cyber attack?
A couple of weeks ago, and they weren't the only ones. I think there were two other.
They were the most publicated one, for sure.
Yeah. So let's have a look elsewhere. Should we cross over to Germany now? Because Germany, the DAX is having a pretty good day. Why is it when I try and add my watch list to a bigger screen, it doesn't then allow me to then filter it? I must talk to the DevOps. Ron's looking at you like you're asking me, because I make a lot of watch lists for myself, and what I find is that if you make it large and you add it to your worktop, so it's the whole thing, it stops you from filtering the winners and losers.
Yeah.
Right. So here are the winners.
We got the winners. We got Adidas, Daimler, Porsche. They're all up, doing very, very well. The autos are for once doing well, which is, I guess, a nice little surprise with both Porsche, BMW, and Mercedes-Benz and Volkswagen all being to be found in the gainers list. Yesterday, Rheinmetall had an absolute screamer of a day after the 5% defense budgets came, 5% of GDP defense spending came out. They were rallying up 7.5%, if not more. But yeah, I'm happy to see that the autos get a bit of a breathing room. And Adidas definitely up on the rally as well, on the back of the Nike results. And I think this plays well into Andrew McKelvey's play of JD Sports doing well on the back of these fashion brands. Very, very interesting to see. What is popping out at you, Ange?
Well, I like the fact that you talked about the automakers being up because they were down. Don't forget, trader friends, they were under pressure when the geopolitical situation in the Middle East started kicking off. So we're seeing a bit of respite there for them. Also, the fact that you talked about Rheinmetall. Yes, we saw that they ticked up. This is a German contractor. And did really, really well, but giving back some of those gains, which is only natural, right? After such a huge
taking a bit of profit
move. I mean, they were some of the top gainers in European defense firms. Also checking in on Fincantieri. This is Italy's Fincantieri, and earlier today, if you want to read out on the YouTube chat, I gave our trader friends a heads up. At 7:59 people, the upgrade and downgrade Fincantieri, Deutsche Bank there, initiating coverage with buy rating, target price. Fincantieri, also one of the ones that, really benefited from this defense spending, increase in defense spending, because it received an order worth some $820 million because of this NATO spending pledge. So off to France now. Let's head off to France because we haven't checked on the France 40. So that's the winners over there.
Carrying are continuing. We get the autos up here as well with Renault and Stellantis all doing very well, but I'm surprised to see Kering up there. Seems like they're continuing the rally of the new CEO, and that's another turnaround company that we're gonna keep a close eye on. Are you a believer in the Kering turnaround plan? You're a big Gucci spender?
I'm very I don't wear luxury,
right?
Because I understand how much luxury costs.
Because wealth whispers.
Wealth whispers. But I do invest in luxury, and I'm very much an Hermes kind of girl.
Okay.
In good times and bad times, the super rich don't really get hit. So if you stick with Hermes, which is, there's a saying amongst luxury analysts. If you buy LVMH or Gucci, you're just coming into the market. You're not even considered. You're just kind of like just entry level.
Right.
If you buy Vuitton, you are mid-level. However, trader friends, if you buy Hermes or you receive Hermes, you have arrived, yeah? You have arrived, Ronnie. Have you arrived?
No, far from it.
And so Hermes tends to lead the pack, and I really like it because it really does, it's a diversification in my portfolio. But when you see, markets tank and you see all the others fall, the likelihood is Hermes will be the only one in the black, or in our case on the IG platform, in the blue. Kering, I'm going to wait a bit. I'm not so sure the turnaround plan is going to really take hold just yet. I think it will, certainly. But until I see people streaming into those shops that Kering owns in the airports, then I'll start getting excited.
What about some Chinese live shopping? Those streams.
I'm not a retail person. I don't like shopping.
Sorry, you're...
People in the gallery call me fake Asian, because
fake Asian.
It could never be trader friends because, I prefer investing.
Okay.
Different type of shopping. Different type of shopping. Speaking of which, let's
A
get
great
you.
role model.
Let's get you across. Probably why my shoes are falling apart, or my trousers are falling. I need to go shopping. Maybe I need to appoint someone to do my shopping for me. Just getting you across some of the tradable data because there are now some coming through that I have started seeing on my screen here. Centrica might be one that's interesting. Let's just have a look at that. Sorry, were there any others that you wanted to look at?
No, it was. I mean, it was interesting to see that the autos are doing well across the European markets. But
Yeah, let's just cross over quickly to. I mean, not many losers there, but let's just quickly have a look. Thales,
Unibail, Rodamco, the owners of the sort of Westfield. Yeah, I mean, commercial real estate, never anything exciting going on there.
No, not really. But also taking a look at Thales, this is the minute chart, but let's give you the daily. As you can see here, Thales also had that bounce the day before, much like your Rheinmetalls and your other defense stocks, but now it's giving back some of those gains, which is only natural. Right, here are the poll results. Ron Dog, read them out for us.
Right, how many cuts do you expect the Fed to make this year? 1 to 2 says 63% says 1 to 2, 19% says none, including me. Only time will tell gets 12% of the votes, and 3 to 4 gets 4%. That's probably producer Phil from the beach.
It is producer Phil and Rich on the beach. Right, Entropy Kilby is on fire at the moment. Yeah, well done you. And, look at the JD and Adidas. And also, we were looking at, you were talking about Puma earlier on.
Puma, Adidas and Nike, the whole trinity.
Yeah, Boise, late to the show, Boise, on the naughty step for you with... Katie as well from New Zealand. Didn't see her today. Is she already on the naughty step? We did talk about Nike. The initial reason for that 10% jump is because of the expectations turnaround plan is going to take hold. I'm being told in the ear that we have to go to break, so ask the rest in the chat for an update. Ronnie, always a pleasure.
Thank you, Ange.
We are going to be back with Ronnie and Martin after this.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
Hello trader friends and welcome back. I am now joined with Martin Harris, our great portfolio manager. How are you today?
Yeah, good to be here, Ronnie. How are you doing?
You know what? When I've got you across to me, there's nothing to complain about, mate. So Angie and I talked a little bit about Nike, what's going on in America, and we even had on, just to start you off, ease you into it, we had a poll on how many rate cuts we expect from the Fed this year. Do you have any expectations on what's your prediction here?
Do we have the results?
We have the results up.
I'm going with one cut.
One cut, so you fall in with the majority.
Yeah, there we go. I mean, Jerome Powell, his term ends next year, May, I think.
Yeah.
So, you know, this is his last tour, and he knows that he wants to, you know, break the back of inflation. He does not want to leave the seat with this sort of uncontrolled inflation in the United States. You've obviously got Donald Trump wanting to apply some pressure on his man.
Very in a correct manner, of course.
Yeah.
Never overstepping any boundaries.
No, not at all. And so should we be concerned about the Fed holding rates higher at the moment? Yes and no. I think there's a situation where Jerome Powell needs to see the data first. We've got a lot of talk around tariffs, which we'll go into, but also we've just come back off of the verge of World War III. Might happen again. Jerome Powell needs to wait and see if any of that data starts affecting the US economy. Yeah. He's got a mandate to protect, and so he's not going to preemptively start cutting rates just because Trump says it's time.
Absolutely. That would be a job for whichever puppet is in place next. But speaking of the American economy, Angie and I were talking about US exceptionalism, and that there's been a lot of things that, you know, you think that this is finally going to break it, whether it be the higher interest rates, whether it be DeepSeek, whether it be us potentially going into World War III. Nothing's actually managed to break the American economy and the American markets. NASDAQ are now rallying to new all-time highs. Triple Q close to an all-time high. So my question to you, Mr. Harris, I have two questions for you actually. Sorry, two. Two questions. First one, which event did you think that, okay, this is finally going to be the one that breaks it? That's question number one. And question number two is, what do you believe is the sort of catalyst that can finally eventually break the American exceptionalism, or is there even one?
All right, so I think you mentioned a lot of key topics. I think, you know, US markets trading at a whisper of, within a whisker of all-time highs. I think S&P 500 is priced now at 22 times forward earnings, which is expensive. But the alternatives are that, you know, you go and you invest in emerging markets, you invest in places like Japan, Europe. Up until now, Europe was doing almost nothing. Yeah. And so the rally in Europe is on the back of a rotation away from the United States and on fiscal stimulus, and those coincided with each other. You've got a US market that has provided, and you can simply not find this anywhere else, year-over-year expansion in margins, year-over-year expansion return on equity, and so the alternative, and this is where the exception comes from, is that there's no other market that provides these kind of gains, and so everyone is concentrated in that space. That is the risk to the US market, is that people are so heavily long US. And that was certainly, we were looking at that up until April. People have diversified slightly since then. So the potential correction might not be as severe simply because there's more money in other places. What we are starting to see now is that money is returning back to US markets. When you take a look at the ETF flows, retail buyers really stuck to buying the dip over the April crash. So in terms of the risk is that I think that the market is still in a good space. I think earnings growth remains elevated, and we, in terms of expectations, things continue to tick along in a positive way. However, the market is expensive, and the US consumer, and in many parts of the globe, the global consumer is squeezed, and that's because of the multi-year inflation hike that we've been facing. So that's my concern. In terms of, just back to your question, I think DeepSeek was the number one sort of issue that I really thought was going to create that hiccup in the market. You saw Chinese AI firms coming out and able to spend, couple
$12.
million. Yeah. Say $12. They supposedly spent only a few million and were able to replicate the same type of model that the American firms had been spending billions.
Yeah, and it shook the market for about 2 hours, it feels like, almost. And then
it's about 12 hours.
Yeah, and then everyone expected for the next earning calls for Alphabet, for Meta, everyone to come out, and Nvidia to revise their predictions. But everyone just came out and said, no, we're not going to decrease our capex, we're actually increasing it.
Yeah.
And then it's like, all right, fine, moving on to the next thing, continue the rally.
Yeah, I think the message that came out of that is that the hardware producers, so the likes of Nvidia, they were still going to be ultimate winners, and it was actually really the software guys who their moat had been totally eroded. Is that if you can just copy someone else's LLM and produce it for a lower fee, you start to make ChatGPT irrelevant if you can get the likes of Perplexity to do the exact same thing at a lower compute cost.
Yeah.
But now imagine if you can then just have better and better computers. And so you can that model continues to improve. So Nvidia still emerged as a winner there, but certainly the valuations that we saw on the AI software firms dipped considerably following that.
Absolutely. And you, as a portfolio manager for IG, you work with, you have got thousands of portfolios to construct, and you're working with BlackRock for IG Smart Portfolio, and you sort of look at these things all the time in order to manage the risk and balance growth with opportunity. So how have these sort of recent market developments and the sort of uptick in emerging markets and US and Europe, how have these things sort of come into play and affected your decision making in the portfolio construction? What are the things that you're looking at, and how has this affected your decisions?
Right. So I think we managed to make some good adjustments early this year that actually benefited us in the April drawdown, and we're making some more adjustments at present. So the first thing was that we went into Europe prior to the rally, and we're not saying like, oh, we predicted 100% of the portfolio went in there, but ultimately Europe was a great value play. It was really cheap. Both Europe and the UK were really cheap, and we had a really strong conviction into going into defensive stocks. Now, the push into the defense stocks was that the NATO members had to start meeting the 2% target, which has now been revised up to 5%. Only Spain are pushing back against that.
Mañana.
There's a lot of factors in there. We won't get into too much detail, but the NATO members often stuffing that 2% of GDP with things like soldiers' pensions and whatnot. So it's not just R&D expense and actual boots on the ground expense. It's also covering, administrative expenses and things like that. So Donald Trump's obviously aware of that, and that's why he came down on them hard, wanted to get everyone spending more money. Otherwise, the US isn't going to be involved to protect them because they're not meeting their obligation. Yeah. So that was already a trend in Donald Trump's previous term. Donald Trump started coming to presidency again end of last year. That was a factor that we wanted to play on. Europe was we predicted that there needed to be some kind of fiscal stimulus in Europe based on that. We didn't think it would be so isolated to Germany at the time. But yeah, so we started to expand into Europe or increase our exposure to Europe. And the second thing was that S&P 500 really started to broaden out in the middle of this year. And so we had started to include a equal weight S&P 500. One, to diversify our exposure away from just Mag 7 because it's not sort of really concentrated there. Yeah, exactly.
Away from the tech stocks.
Exactly. So just to try and broaden exposure away from just tech stocks and get exposure to the broader US market, and that has played out really well. I really like equal weight at these levels, because you then just reduce your concentration to the likes of the hyperscalers.
You still get NVIDIA and the Mag 7 exposure, just not as concentrated.
Exactly. So I think the big thing in investing is I always like the approach of always on investing and just shifting where, how much risk you're taking. And this allows you to be invested, but to reduce your overall risk. And so if there's any kind of blip to the hyperscalers, that's going to really affect S&P, not just NASDAQ anymore. Yeah. And so you want to try and diversify exposure there.
That's a very interesting take, and it's always, obviously very important to sort of manage your risk and see how you can move it across. I like what you say about always on, sort of not just pulling your money out and not being invested in the market, but actually just shifting where you are invested in order to be better positioned to, move away from all the risk or also gain on the upside. But if we're going to move into some individual stocks, we talked a lot about Nike earlier this morning. What do you think about the sort of Nike as a stock, but also the American consumer itself? Do you believe that it's something that will continue to be strong as we move into the end of the year, or how do you think that this is going to play out?
So I think there's a few things to talk about. So one is sort of apparel and footwear and how the tariffs are going to affect them. The apparel and footwear companies have been front and center of in 2025 due to this kind of proposed implemented tariffs from the new administration. Earlier, when Donald Trump had put up that beautiful Excel boards that he held up, indicating that countries like Vietnam were going to get heavily tariffed.
Yeah.
And already in the previous, Biden administration, they had, and even when Trump was previous Trump administration, there was a push for American companies to exit China and go into friendlier nations. So it was the friend-shoring sort of exodus from China. And Vietnam was one of the beneficiaries of that. US has got a better relationship with them. Nike had moved a lot of operations out of China into Vietnam, and boom, hit with tariffs again. So they had complied with exactly what Donald Trump had wanted in his previous administration, and then he smashed tariffs on them. And the cost of that was, overnight, a lot of these retailers had to move a lot of stock out of the Far East and back into United States at huge expense. There were talks about, even the likes of Apple having to just fill Boeings with iPhones and bring them over prior to the tariffs coming in because the communication was just so poor. Then we got the delays to tariffs, but that cost still impacts, these companies. So just on average, footwear and apparel sub-industries fell over 30% in April. And on average, we've only recovered a third of that drop in that market since. So a lot of these companies still seeing significant compression on earnings estimates. If we look at Nike in particular, I'm just going to pull up, I've got some notes that I actually had on Nike. I'm glad we got to speak about it now. But I think if we look at the earnings report that came out, I think Tuesday night may have come out. Earnings per share is at 0.14 cents above consensus estimates on revenue. So there was a lot of positive news there. And by channel, Nike Direct revenues declined by 14%, while wholesale only declined by 9%. Now, the big move in Nike was that they had pushed their direct channels to overtake wholesale. They actually didn't want to use retailers anymore. Big one, the likes of Foot Locker in America. Here it would be, JD Sports. Which
is rallying today on the back of this news.
Exactly. And so they've had to reverse those decisions and start putting their shoes in more wholesalers and sort of discount retailers. China declined 20%. Emerging markets declined, excluding China, declined 10%. Latin America down 8%. So overall, negative news on Nike, but this was to be expected. A large portion of what they had mentioned that they needed to do was actually cut discount sales. So they were cutting the kind of production lines. They were going to stop producing a lot of the kind of cheaper discount shoes and just try and focus on the premium sector to try and claw back some margin. And as I mentioned, use the retailers again, because they now need to take back market share from the likes of Hoka
On running,
and Adidas
Lululemon.
on running, who just took up all the Nike shelf space. So based on this, Nike is still expensive. This is not yet a discount stock. I think I don't know if we want to pull up a chart. I can actually do that.
Yeah.
Yeah, I'll get it up.
But before we move to the Nike chart, while we're on the topic of China, we have seen a U.S. trade deal now with China. Yep. No details have been given, and there's the removal of the sort of revenge tax. Is this something that you believe is going to have a long-term positive effect on the likes of Nike, Hoka, On Running, or whichever American companies have a Chinese exposure? Or is this something you think that is just, something to ease the market?
Yeah, I think the Trump administration talks about implementing tariffs long before 2025. I think things were unexpected on the 2nd of April. And so they've remained firm on a 10% baseline
Can we get much higher? It's Thursday, June 26th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilias Pivek in San Francisco, Thomas Westwater in Chicago, taking you through the rest of this trading day. Futures market closes at 5 Eastern, 4 Central. If you're on the platform on tastylive.com, welcome. Thank you for joining us. Come over to YouTube. Tell us what you think of this action, this listless melt up in markets. Low volumes, low volatility define the day. The S&P 500 doesn't clear 1 million contracts traded. No, sir. Or ma'am, whoever's listening. But we do see a push here in the triple Qs and NDX to fresh.
Might have based on what I think is attractive right then.
How often do you change it up, Tom? Because we often talk about, the don't tinker too much, and your portfolio should be sort of the number of times you look at it should be the number of times you go to a hygienist, maybe, as a good way of remembering. How often do you reallocate and think, okay, my thesis, I might need to take another look at this?
Well, that kind of not tricky portfolio is very much the kind of the Jack Bogle approach. If you're doing just basic asset allocation, bonds, stocks, maybe a bit of gold, then sure, you're not going to tinker with it too much. But if you are looking at some of these themes, you might have a more tactical approach, and so you're realizing you're going to buy this sort of theme or this sector exposure for a reason because you think it's attractive right now, but you're going to obviously be monitoring that to realize when you no longer think it is a thesis, or your thesis is played out and you're looking for the next one. So it's really a hard question in terms of to answer in abstract sense because everyone has their own different approach. Personally, I'm looking at my portfolio. It's hard not to, given where I work, obviously, to always be thinking about it. But generally, I'm probably only in and out of an ETF once or twice a year.
Right. Thank you very much, Tom. We have to go to a hard out because we are going to our next segment. Thank you very much, Andrew and Steve. Hope that helped, and Arsax as well, and Monkey Man. Thank you so much for your questions. And if you want more on ETFs, please slam it here, like and subscribe, and we will bring more of that good content to you guys. Right.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hey, trader friends, welcome back to All Sessions. We are 1 minute to go here, and if anything in Europe is anything good by, it's going to be a risk on for many of the All Sessions stocks here. Just getting my list on. I've got the bell ready for you. This is going to be a really exciting day. Also, of course, we are watching out for some of the reaction across the board after that positive news from Nike as well. How many more minutes to go, people? Got 40 seconds to go. Just to give you a brief outline of where we are at the moment, European stocks did open higher. Of course, many investors and the markets, they're still keeping an eye on the ongoing fragile ceasefire between Israel and Iran. Also keeping an eye on some of the defense stocks, because some of them that give back after the bounce we saw yesterday after NATO's decision to hike spending. How many more seconds? 5, 4, 3, 2, 1. And here we go. We are off and having a look at my screen there and pressing the button so we can zoom in for you and take a look at Nike All Sessions there. Up 10.2% there. Whew. Hope you got that in the bag, Andrew McKilvey. Novo Nordisk as well, up 2%. And we've got some of the bigger names there in the consumer space. Lululemon following Nike higher. Presumably that is what's giving it that lift there. We've got Issa coming up a little later on to do the week ahead as usual with me. And I'm sure he's going to gloat about Nike because we have that ongoing bet, Nike versus Lululemon. Who will gain the most, which stock will gain the most in 12 months. But we also have Supermicro, Peloton and Palantir also riding higher there. Some of the quantum computing stocks also making some good gains there. And Monkey Man, Hims and Hers up more than 1% there. Switching across to the losers list, we've got Tilray at the top, down almost 3% there. But also a smattering of some of the space names. Virgin Galactic down 2/3%. But we also have General Motors down ever so slightly. But really, it is a risk on day overall, following the other indices higher as well. Just checking in on that for you, because markets at the moment, at least, are looking optimistic that this fragile ceasefire is going to hold. Plus, don't forget, we have quite a few releases coming up today as well. We've got a smattering of US consumer data coming out. So we've got the Michigan sentiment, the latest reading on that. We also have a print on US spending, so keep an eye on that as well. Just taking a look at the European stocks for you a bit closer, because earlier on in the day, you heard me talk about rip-roaring Germany 40, and just taking a look at the autos there for you. So the Porsche, the Daimler, the Mercedes-Benz, or otherwise known as Benzi in Asia, they are all driving, roaring higher there. Volkswagen also up more than 8%. And that is predominantly because the White House has hinted at a tariff deadline extension. That is right. They have hinted, haven't actually confirmed, but the White House spokesperson, if you've been following that, has hinted or suggested that actually the looming deadline for country-specific tariffs that are expected to come into effect very soon was, quote, not critical and, quote, could be extended. So markets taking that as perhaps, the Trump administration might be kicking those deadlines kicking that can further down the road. This also coming in a time when Beijing said it had essentially agreed with Washington on details of a trade agreement which they inked in London earlier. So if you remember, the Chinese came to town, the US officials came to town. Rich was here saying, hey, Ange, any idea from your sources where they're going to be meeting? And I said, look, there are only a few places that have these security measures where they can meet, which is also in their sphere of not being too far from Chinatown. So really easy Venn diagram there, really. I did not reveal where they were staying, but I did tell Rich later on it's likely to be this place, and it turned out to be right. So also top movers, other than the Porsches and the Volkswagens, we also have part suppliers like Valeo are also driving higher. Let's have a look at that for you. There we go. Valeo up more than 2% there. And I'm almost willing to bet money that Stellantis is also going to be higher. There we go. Automakers and the parts makers tend to move in a herd. So this is the 1 minute chart there showing you the move there. Take a look at machinery as well as we get closer. So machinery related stocks, as we get closer to those deadlines, because don't forget, it's not just auto stocks, but machinery related stocks, because the EU, of course, is one of the biggest exporters of vehicles and machinery to the United States. Right, we're going to have Isar coming up next to talk about the week ahead. So any questions, do give us an email or slam it here. And don't forget to like and subscribe, because we can't keep bringing you all this nice, good, tradable insight if you don't like and subscribe. Get your mom, your dad, your hamster. Those of you that haven't, we need to have a poll on the list. Who hasn't subscribed yet? Do not be a freeloader. Do not be a freeloader. We are going to get Issa in right after this, so don't go away.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hey, trader friends! Welcome back to the show. We have Issa with us. Hello. We've been waiting for you because when we covered Nike's move, everyone was like, "And you're going to get it in the neck from Issa."
It was admittedly bad earnings, but just not quite as bad as we were expecting. And that's kind of what I said, right? It's like it was such a beaten up stock. Expectations were so low that I think when you compare it with like a Lululemon, like Nike doesn't have to do that well to then start to have a bit of a rally. And in fact, all they have to do is not badly. So I think week on week, Nike's up 5%. Yeah. And like Lulu's only up about 1%. So I've got a 4% lead.
He has got a
4% lead going
into
his
pair of shoes.
So maybe reminder for people at home, Ange and I have a bet. If Lululemon over the next 1 year performs better than Nike over the next 1 year, then I buy you, what is the name of the kind of gilet jacket thing
Lululemon, it's like a jacket that cuts out the wind and, like a runner's jacket.
There you
go. Also is waterproof, with zip pockets because I'm pragmatic like that.
Yeah.
I never carry a bag.
Well,
I just love big pockets.
This, by the way, is why Lululemon's doing so well. And then if Nike outperforms Lululemon, then you will buy me a beautiful pair of Air Force Ones. So,
hey, you didn't say Air Force Ones the last time. You just said a pair of shoes.
A pair of shoes. I've now decided.
You can't. Wait, you cannot suddenly put that in. It's been underwritten. That.
Okay. Fine. A pair of Nike shoes.
I mean, look at that. And also, like, I was right in that I expected the results not to be great, but I think this is like shut up. This is more the fact that the market I think bet on the fact that Elliott Hill's restructuring and turnaround plan is now going to start bearing fruit.
I mean, we're still in early days, right? Like, I think having change in leadership, having clear plans, those are prerequisites for the stock doing a bit of a turnaround. But actually, if we're looking at the 1 year time horizon, we actually do need to see some results from Nike. So fingers crossed, it's a nice early lead, but I'm sure it's going to get dicier as the year goes on.
Yeah, let's see if he can push this through. Elliott, I'm counting on you not to do it. Monkey Man saying, and I still don't have any Nike shoes. I don't either.
I do. I own a bunch of Nikes. And so does Rich. I think.
No, I'm more a Converse kind of person.
I'm currently wearing New Balance shoes, so
New Balance is good.
That probably says a lot about Nike's brand.
Apparently, New Balance is coming back.
The New Balance is great. Like, the dad shoe is still in.
Yeah. So Arsak's chiming in saying try Brooks. I've not tried Brooks.
I think if you want a really great undervalued stock in the shoe sector, looking at Deckers or looking at Crocs are probably really good shouts. I think Crocs in particular, I am pretty bullish on.
Tom Sosnoff last week.
Bullish or not so bullish?
We had.
I always feel scared when
Brad Hackney.
Yeah.
I was eyeing what shoes he was wearing.
Was he wearing Crocs? No way. See, that's
at least it was
bullish.
a really good knockoff.
I I just don't think the knockoffs feel as comfy as the OG Crocs.
The OG.
Yeah, no, but Crocs as a business is going through quite an interesting period. They have a brand called Hey Dude, which is like not doing very well. And so I think basically if they can keep laser focused on the core brand, I think they'll do well. But otherwise, I think it's not quite as positive, and their valuation actually at the moment is quite attractive. So definitely an interesting one to look at. The other thing I wanted to talk about before we look at the week ahead is, I don't know if people saw, but yesterday IG launched its SOS campaign, Save Our Stock Market. I think...
I'm going to show this to you guys.
Yeah, pull it up. So basically, the UK stock market has been really struggling for quite a long time. If you look at London Stock Exchange listed companies, they haven't had the growth or the multiples that kind of US companies have had. The IPO market has been totally stagnant. And fundamentally, I think most individual investors are, in the UK in particular, are underinvested in stocks, especially retail investors when you compare them with like the US. And so I think there's really an opportunity now. You can see here, if you scroll down, actually, you can see what we have a kind of 4-point plan for how to do that. But basically, we really want retail investors to start looking for growth opportunities in the FTSE and in like London Stock Exchange listed companies. I think that's good for them because it will potentially boost their returns. It's good for the stock market to have the liquidity and the support. I think it's good for companies that maybe want to IPO in the UK. And I think it's fundamentally just good for the economy. So I think this is one of those situations where the situation is bad at the moment, and I think there's a potential for a kind of win-win-win for individual companies that are listed, for companies that want to IPO, for retail investors, and for the economy more generally.
Yeah, and if you want to find out more about what Isa's been telling you about this launch of the SOS campaign here, you can go there, or you can also go to my Twitter page there, and I've also, for those of you that follow me on Twitter, I've also put it on there so you can see it. But also, we've also come off my page now, we've also put the link on our chat as well. There you go, ig.com.
Yeah, and if people are on LinkedIn, there's also some great content there about it.
Yeah.
I think go read up. I think this is a kind of movement that is really important. And I think we have historically really had a struggle getting people to invest in the UK. And I think the solution, in my view, is not the kind of necessarily the kind of Rachel Reeves style forcing people to invest. I think it's really about trying to find the growth opportunities and helping retail customers kind of understand what the value is.
It's all about, educating people to make better choices, right? I mean, you're not going to be able to strong arm people into investing.
And look, we've seen a bit of a rotation trade already, right? We've seen this kind of, there's this like sectoral rotation out of some of the US names and into other names. We've seen like changes in currency rates to reflect that. You've seen the dollar weaken. So I think, I think now is kind of a turning point and a precipice moment that I think is really important.
Yeah, totally. And for those of you that want to know more about this, there will be more in the weekend press as well, or if you read City Index, it's also in there. And I think we were also covered in The Guardian yesterday too.
Always nice to get some coverage, but I do think this is a really important topic.
It is very important. Bigger Beer is chiming in, saying the IP market in the US has been hot lately. That's right. And also, I think Lime, as in Lime Bikes, there was a report earlier on, they were also looking to list in New York.
Yeah, and we've had a couple of instances where companies were thinking of listing in the UK and then opted not to and have instead listed in the US. And I think that is a sign of the relative like strength and kind of healthiness of the market. And so I think we want to try and create some of that opportunity in the UK.
Yeah, totally. Right.
Should we crack on with the week ahead?
The week ahead.
So I think this is kind of a weird week. It's a weird week for a couple of reasons. It's a weird week because there's not any earnings really. We're in the kind of quiet period before the
lull.
next. Exactly, the lull before the next earnings cycle. In fact, a lot of companies are about to go into their buyback blackout period this week, and so actually a lot of them won't even be buying shares back for the next kind of couple of weeks as they kind of close the books and then kick off the next quarter's earnings. The second reason is because we have some looming deadlines, not next week, but the week after and the week after that. So we've got, in particular, the deadlines currently scheduled for some of the tariff pauses. On the 9th of July, you have the original, do you remember when Trump brought out the big wooden board?
I know that looked like it had been stolen from a cafe.
Exactly. Like someone ran to a Ryman's and printed it out.
Yeah, quick, do it right now.
So the deadline for those tariffs is the 9th of July, and then the deadline for the second set of tariffs that were on China specifically is on the 15th of July.
Yeah.
So next week is again a bit of a lull before that storm. And then the final reason is also we just have a bit of a lull of macro data. So we have some macro data next week, largely around jobs, but the big data is probably going to be what the June CPI print is, which is not for a couple of weeks.
Yeah. So ahead of this, and also because I've been coming in early because super early because Rich is on the beach somewhere, and I think he's on the beach somewhere. Because I was like, what are you going to do in Milan for 6 days or whatever after, right? Because Milan's great.
Milan is great,
Like,
but
6 days in Milan is
and it's so easy to take the train.
it is so easy. Actually, Italian trains are great.
Absolutely incredible, right?
Yeah, and the air conditioning works, and
They're all electrified.
cheap.
Yeah, exactly.
So I crunched some data, and I put this together just so we have a quick snapshot.
Oh, wow. Look at this.
Yeah, right. Trade negotiations dashboard, just so that I have like a quick overview of where we are. And as you heard Esna say, some of the key dates, of course, the 9th and the 15th as well. Not forgetting that China has stayed very, very quiet.
Yeah.
Right.
Well, you can see here there was actually a news story this morning about how China is going to be signing a memorandum of understanding with the US, and the final rate of 55% is significantly lower than the 120 something percent.
Eye-watering.
Yeah, which was at one point floated. So I think if I was going to guess, I think if China signs the memorandum of understanding either today or next week, there will be an extension of that Chinese deadline. The question will be what happens to the other deadlines, and will we see kind of a flurry of similar agreements, a little bit like the UK one, where instead of people signing full agreements, they're signing these kind of
MOU.
Yeah, MOU, like not a trade deal, but I promise to do a trade deal soon.
Yeah. And then they send their mandarins in after that to kind of like get it.
Yeah, but you know what the crazy thing is? Even if they sign all of those, we'll probably still end up with a 10% tariff, which is 10% higher than we started with.
Yeah.
And the reality is that most people would have, before this, thought that 10% was huge. It's just compared to like 100% or 70%. We've all been kind of lulled into this sense of security that 10% is very reasonable and very low.
Yeah. It's the whole kind of like ask for something outrageous so that you get the thing that you actually want.
Yeah.
Really good.
It's like true art of the deal stuff.
True art of the deal, but also kids use it a lot, right?
Yeah.
But also the mood music coming out from the White House as well, saying that, it is, quote, these tariff deadline, quote, not critical, quote, not important, but the exact words were critical.
Well, this is the kind of
could be
taco trade,
extended.
right? This is exactly the taco trade sentiment, which is that Trump always chickens out. My kind of worry with this, though, is that if they just extend the deadline and then they keep extending the deadline and they keep extending the deadline, we're just left in this weird period of uncertainty. And at the moment, that's not really being priced in at all. And maybe that's fine. But like...
But this is why
it's just weird, right?
and that's why it gets me so slightly annoyed, because lots of people, and I get calls from the press as well to talk on the press, and they're like, oh, it's terrible. Why is it markets aren't reacting as they should to like the Friday the 13th?
I guess because he's just not a credible actor, right?
Yeah, and because they've seen this so many times before, right? It's like the boy who cried wolf, and then now markets are becoming more and more alarmed. Yeah.
But occasionally there might be a wolf fan.
But then look at what happened with in Iran and Israel. I mean, that was like a big thing. And look at markets, volatility was crushed.
Immediately.
Yeah, and also the fact that, gold ease. Yeah. And oil didn't do what it normally should have done, right, in that sort of normal circumstance. That was a big thing. I mean...
But I think if we look at the trade deal situation and we look at the Iran-Israel situation, I think we're in a situation where in both cases the risk is materially lower than it could have been, especially if we look like 3 or 4 weeks ago. But because that risk is lower, because everyone's kind of pricing in the ceasefire for Iran-Israel and everyone's pricing in a deadline extension, I worry that going into the weekend, if there is any risk, it's all downside risk.
Yeah.
And so like, I think the reality is that I don't think that risk is very high, but the direction of it isn't super appealing to me. And so like, I think this is maybe a Friday where people take a bit of risk off and they make sure they're positioned, not bearishly, but just a little bit more hedged than they would otherwise.
Yeah. You know, it may be that they come off, you know, before the string of data points that we've got later.
100% right. So that's the other thing for this week. So there's 3 major data points from a US macro perspective that I think are important. So today we have the PCE data. I think the PCE is never a massive surprise because it's essentially a weighted average of the CPI and the PPI. We're expecting it to come in like in line with expectations, but that is the data that we'll get today. We'll also get JOLTS data, which is the kind of US job opening report. We'll get that on Tuesday, so it'll be interesting to see the kind of state of the labor market. And then we'll get a kind of second data point on the state of the labor market on Thursday when we'll get the non-farm payroll data. And so I think in both cases we'll see like, is there any major change in jobs? I think there's been quite a few headlines, especially about big tech layoffs.
Yeah.
But I think if you look at the overall jobs data, it's been decently robust.
It is decent, and actually, for you know everything that the economy's gone through so far, still looking resilient.
Just chugging on, right?
I know.
The US economy just seems totally unfazed.
I'm just thinking, like, what is with you people? Do you have like all these like you know amazing bank accounts that can continue on, you know, forever?
Well, there are some early signs of consumer distress in things like, for example, credit delinquencies.
Yes.
Things like credit card amounts, in particular things like looking at student loan defaults, because now a lot of US consumers have to pay back their student loans in a way they haven't historically. And actually a lot of the buy now, pay later stuff as well is now going to start getting reported to credit ratings agencies.
And we've seen that the buy now, pay later, the Klarna and the Affirms all doing badly
Yeah,
now.
the numbers have been soft, right?
Yeah, because
so I think there are some early indications of that, but I think if we're looking at the core underlying headline data, jobs have been robust. People seem to still be consuming. A lot of the earnings data has still been robust. So until we start seeing the cracks, probably in the upcoming round of earnings, I think I'm not too worried about the state of the labor market or the US consumer.
Yeah. So trader friends, some of you asked me, and what calendar do you like? Obviously, we have the economic calendar.
It's actually, the IG one is really, really good.
Yeah.
I don't know if you want to pull it up.
Yeah, here we are.
I used to use, many years ago, I used to use the Market Watch calendar. And actually, I find the IG one way easier. So I typically, if you look at, next 7 days ahead, if you go to the PCE one on today, if you go back to today and you go to PCE and you click it.
This one?
Yeah, that one. You can actually even see a chart of what the data has looked like historically.
Yes.
And
my
trigger finger.
Yeah, trigger finger, fat finger. Oh, okay. So
but if you go to the PCE data, any of those, exactly. You can actually see where the historic data has been. I find that really useful, and you can also see the timing in whatever your local time zone is.
Yeah.
If you actually click the earnings tab, you can also see not just the macro data, but also the earnings data. But one of the things you can see, this is a quiet day, and the next 7 days are quiet. But actually, as you start to look further ahead, you can actually see a couple of earnings.
There is also one quirk. I'm sure you found it.
Yeah.
And I've helped our trader friends iron that out. So if you want to have the UK in the mix as well, it is important to have your that button clicked.
Yeah, because a lot of them are lower volatility names.
Yeah.
So they're rated as low importance.
Yeah, that's one I get asked, like, hey, Ange, what happened to all the UK stocks I want to... And I was like, have you got the low tick?
Yeah. I think, and then the other thing worth saying is actually, unlike a lot of other calendars, we actually have dividend splits and IPOs. I think we were hearing from the chat, like some of the US IPO market has been a bit more interesting recently. I think dividends it's actually been a great time to be thinking about dividend investing because the returns have been really good for some of the value names. So I actually think some of this kind of functionality is really great. There are, of course, other economic calendars available. I occasionally use some of the like Fed Watch tools from CME. There are like a couple of good ones.
So the one that I like most, and this is just because I used to work at Bloomberg, so I just it's something I'm used to, is this Bloomberg economic calendar. And you just go to the filters. It's really easy. If you are trading different regions,
if you want your
countries,
Kazakhstani stock names.
what I always find, what tickles me is when you go down, each one has a flag except for Taiwan.
Yeah.
Ah.
Which is probably a thoughtful decision.
But what's cool is you can also, at the bottom here, select your category. So I love central banks. So sometimes I will click that if I'm looking out for that. You can also, filter for inflation. Every time you hear me say the word scrape, I actually mean filter. So I've been filtering for a lot of our clients. They want more upgrades and downgrades. Cool. So I've been designing filters for that too. You can change the time on the right top left-hand corner, so to whichever time zone you want. And over here,
that's particularly good, I guess, if you're traveling, you want to be in a different time zone.
And you just don't want the guesswork, right? And then what I like about the right-hand side is you can have the whole week if you want to, let's just say, or you can go like individual days. Let's say I just wanted Monday the 30th, click apply, for example, or let's just say it's today. I don't want the weekend, and just click apply.
Yeah, and that same stuff, by the way, you can do in the same IG one. Where you can set custom dates.
Yeah, totally. And then forecast previous. It's just like a snapshot, right? I want it at one page. So just a few handy tips for all of you. We have a poll. The poll's out. Look.
Who is? Oh, look at that. I knew I liked you guys. That's.
Did he put you up to this? Did he?
No, it's just the market wants one.
12 more months to go.
12 more months to go. Well, 11 months and 3 weeks or whatever. Yeah.
Bigger B is saying JP Morgan Chase, there is a stress test coming for US banks.
That is true,
today.
yes.
The results of the 2025 US bank stress test will.
What do you think? What do you think is going to be the outcome of that? I think you've still got a couple of big US banks that have quite a lot of unrealized losses on their balance sheets. The one that is famously quite bad is Bank of America. JP Morgan, I think, is in a much better position relative to some of the other big names, just because they are such a juggernaut with so many different arms and revenue streams that actually their capital requirements are a little bit less stringent than, for example, Bank of America.
Yeah. I mean, I just think that it's going to be relatively fine.
Yeah.
And what I find...
well, I have a friend, actually, who his job is to do stress tests.
Oh!
Which is fascinating. And he was basically saying, like, it's funny...
It sounds like a fun job.
I think it's very spiky. Like, they have extremely intense periods and then, like, lulls between some of the big stress tests. And I think a lot of the reporting tends to not be a surprise by the time it comes out, right? Yeah, I can see bigger beats has said JP Morgan, Goldman, BAML, Wells Fargo, all at all-time highs. And I think of that name, the two I would be most worried about is your Bank of America and your Wells Fargo. They have much more of a retail exposure to them. They both have higher levels of unrealized losses. Wells Fargo famously had the disastrous credit card that they launched about 2 years ago with Built, which is a fintech that offers rewards. The aim of the credit card was, this is like a crazy story, the aim of the credit card was that younger users like millennials and Gen Z could use the credit card to pay their rent and collect points based on their rent. And the way that Wells Fargo basically got people who receive rent to accept this is they waived all their fees.
Right.
And it turns out this credit card was just bleeding cash. Because the kind of people who are young enough and interested enough in optimizing to pay their rent with points are often exactly the point optimizing people who pay off their balances in full every month. And so if you've waived your fees for the largest transaction they do every month, and they pay off their balances in full every month, there's no revenue model.
There's no revenue.
How do they make money?
That's me.
Yeah, well, exactly, right? Exactly.
So I was shocked, Issa,
Yeah.
when I was working in Asia. If you paid off, if you were a long-standing client of the bank, you were the one that got the premium lounge. You were the one that got the platinum card. Right? With the FTs and free coffee and the snacks and stuff. Then I came back here to my country of birth and was like, no, you go back of the line.
Yeah.
If you owe the bank a huge amount and you are always not paying on time, you default on, then you get the premium.
For sure.
Yeah?
For sure.
And I was like, this is
It's so
Okay,
bizarre, right? Yeah.
So yeah, there's for those of you that like gaming the points system, there's also a wonderful site called The Points Guy. Have you read that?
Oh yeah, where he goes through all the
Yeah,
different
this is
cards.
the best.
He's like Martin Lewis, but just for credit card points.
And specifically airline
exactly.
points. So you heard that here first, but really the banking system, I think it's going to be relatively fine. Wells Fargo, incidentally, are trying to, I know that they're hiring big time here because they're trying to grow in Europe.
Tough market to break into though. It's competitive.
is
There's lots of
tough
people.
market.
There's a lot of
Whereas-
challenger banks that offer really great services.
Whereas in the US, it's segregated as hell.
Yeah.
Nothing speaks to anything. I was horrified by
Still have to sign your name.
in your name, where's your pen? What pen? And so, you know, over there it is extremely not
We've had a call out saying, can you do a piece on bank stress tests? I would actually love to. I'm off next week, but it's one of those things where we should definitely do maybe a slightly longer session at some point on stress tests, how they work, what the results are, and how to read some of the results. Because I think there's been like often those reports are quite dense and they're quite hard to read, but it's been important in the past.
I would love that too. And also, some of the people that have the most fun jobs out there, happiest people I've ever met, is the unit of people in the Bank of England that have been hired to clean COVID data.
Oh, really?
And they're absolutely the happiest people because everything's new, right? And they have to clean this data.
Stats nerds. If they find their niche, then nothing they feel happier about.
Darn, I'm gonna try and put this on my screen. Don't put it up yet because can I do that, or is it gonna show everything on my email list? Oh dear. I'm gonna have to track the picture, but Pelican, if you can read out some of the comments there.
Yeah. So we've got Paul who said that the IG economic calendar is pretty good. So shout out to our product team. I think like genuinely our economic calendar is the best in the market, and I think has a bunch of really great data you can't get elsewhere. We have Bigger Beats with some comments about some of these bank stocks at all-time highs. And a call out about the Michigan sentiment numbers. I actually think he's right. One of the things that always comes out with the Michigan sentiment numbers are the 1 year and 5 year ahead inflation expectations. And we've actually seen the 1 year ahead inflation expectations slightly tick up. So I think a great call out, definitely a data point that I look at regularly. Angie, is that enough time to pull up your?
Yes, we're just gonna have to use it this way. A call out to Pelican who came to our event.
Oh no way!
On Friday.
That's
Here we
funny.
go, Pelican. So good to see you. Here he is after the
Don't
event.
dox our users.
I did ask beforehand. I said,
Okay.
can I use your picture, please? We'd love to see you. And Julian and loads of other people who were also at the event.
Shout out to Tom as well. Like, I can't believe he got through, both Tom and Bat
my
got
goodness,
through
it was
40 trades or
Felt-
something
and
crazy.
also in 39 Celsius. It felt
Yeah,
like
it was warm. It was definitely roasting in that theatre.
39 Celsius. I mean, you had that jacket on, didn't you? Or you had
I took it off for the session.
It's just so hot. It's incredible. But loads of people were there and met a load of them. If you can also pull up this. So here are some of our Trade Live with IG clients that came up and basically said hi to us. Let's forget about the F9, FN, F11 because otherwise I can't go to the next one. And that is producer Phil.
Oh, no way. Phil was greeting everyone on the door, plugging the show.
I know, right? Good job, Phil. Who's like, no subscribe, no entry.
Checking people's phones.
Here is C. Lee, I think is the right term. She's a silent Trade Live with IG.
Yes, I met her as well. Yeah.
And here's the set on Friday.
It was packed. Look how many
It
people
was
there.
packed. And I did give, as always, giving you positive skew. I said, if you want to be a bit cooler, although not by much,
Right at
sit
the back.
higher up.
Yeah.
I did tell you that, didn't I?
Yeah.
I said there are also screens on the side, so if, like me, you can't see very well, stick to the side screens. And this is, I think it's Mervyn, is that right? With us at the entrance, and Adam DeLuz, and also Martin, I think Martin was also there with us. There we are. And it was so good to see all of you there.
Wow.
Thank you for coming, right? Have
it's
a
great, it's
great,
great event.
fabulous weekend.
Thank you. And then I'm off for a week, so I'll enjoy that as well.
You know we're going to call you, right?
Yeah, I know. Phil threatened to call me already. He was like, just be ready for a beachside phone call.
Yeah. Just don't wear your Borat outfit.
Yeah.
On that note, have a great weekend, people, and see you all in Discord. Otherwise, we will be back bright-eyed and bushy-tailed on Monday.
Thank you.
Can we get much higher? It's Thursday, June 26th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilias Pivek in San Francisco, Thomas Westwater in Chicago, taking you through the rest of this trading day. Futures market closes at 5 Eastern, 4 Central. If you're on the platform on tastylive.com, welcome. Thank you for joining us. Come over to YouTube. Tell us what you think of this action, this listless melt up in markets, low volumes, low volatility to find the day. The S&P 500, does it clear a million contracts traded? No, sir. Or ma'am, whoever's listening. But we do see a push here in the triple Qs and NDX, two fresh all-time highs. NASDAQ futures barely a few hundred points away. The S&P hits a fresh June high as well. We see here now it's at its highest level since that February 21st PMI growth scare, Ilya. As you make your way around the market, bonds, they are trading up, and they get a little bit of a kick in the pants today, treasuries across the curve, when the Senate parliamentarian comes out and says, you can't cut Medicaid the way that you want to, so maybe the one big beautiful bill, as they're calling it, it's not going to move forward in this deficit form and fashion that we thought. Okay, gold's not so strong, but silver and copper explode to the upside. Oil has a strong day too here, so maybe there's a growth flavor to this market today. Currency is bad for the dollar, which admittedly I'm out of any long dollar positions now in the euro as a result of this. But we have a lot to discuss. We have new highs here coming around the corner. We have ridiculous headlines for sentiment checks, least of which, of course, our resident bear has abandoned his bearish positions. Ilya, apparently, where I sent you the snippet earlier. We're using the blockchain to design shoes in space now. Okay, Ilya, what do we make of this, though? Volume is low. Volatility is absent. It's an 11.5 IVR on the chart right now. What's doing here?
It's very tough to fight a market like this, and I stopped 2 days ago. When we breached the swing high from earlier in June, that U.S. CPI data high, I picked up and left at that point. I mean, obviously, I've been taking on the short side with very small positions, very risk defined, only verticals and only in the ETFs to keep things nice and small and keep risk very, very, very constrained. But even so, you're not going to argue with the price action here. And when we, so certainly I'm not, when you took out that high on the closing basis there, you can see it in the chart. That gray box is at that high, and then you clear that, and so I hung it up right there. I don't think anything has changed for me from a macro perspective, but as ever, if you're right at the wrong time, you're wrong. So I'm not going to sit here and continue to have capital get tied up here. Obviously, these moves don't scream conviction because there's so little volume behind them. We're heading into the July 4th holiday. We've got the July 9th cliffhanger on tariffs that apparently the president says doesn't matter. There's another one shortly thereafter in mid-August. That's the cliffhanger with China. That one probably could matter. But all of those but qualifications don't put any money back into your account if you're short and the price is going up. So I'm not going to fight this thing. I've backed up. My song remains the same, much as it was in the second half of last year. We are operating in a global economy that is dangerously near recession because it has one and only one point of failure. In fact, we're about to get PMI data out of China next week that tell us Europe and China are at standstill, much as they've been over the past 12 months. The only growth that there is U.S. growth. It is a level step down from where it was in the second half of last year, but it is positive. And as long as that doesn't fail, fingers crossed, apparently the markets are okay with pretty much anything. And hopefully the Fed hasn't started cutting rates. And maybe there's a degree of narrative here saying, well, they've still got all the cutting to do. So if only the economy were to take a step in the wrong direction, here they come. They want to be cutting. They'll ride to the rescue. Markets, incidentally, think that they're crazy for not cutting already. In fact, you're seeing the dovish divergence in markets building out here, as we've talked about yesterday, Thomas. So I think we're in a situation where I have not been disabused of any of my bearish thinking in sort of macro terms, but in practical terms, I'm hands off until the market tells me it's time.
Thomas, stocks are continuing to run up higher here. When you and I were speaking earlier today, you said that you weren't into chasing at these levels. Why don't you think this is a good idea to latch on and ride the bull wave right now?
Yeah, I mean, I was thinking about getting a position this morning because there's no reason in the market to keep the buying from going, right? The durable goods orders was pretty good. Initial jobless claims didn't send any warning signs. We're focusing on lower rates now, which we saw in the bond market today. Kept predicting that. It was the light volume holding me back. So it's kind of like you said, a melt up. And I just, I feel that itch when I'm trying to go long of maybe I shouldn't do something. So I'm still holding back here. Of course, in retrospect, I mean, getting long yesterday was probably a good thing, of course. But I said if I was looking at something, I was going to take that SMH position. I had a good run in it today, but I just didn't jump on it.
I think that's one of the key features of this market right now. When you look to something like SMH, the rip higher here after a few days of consolidating back at the end of May, or rather the middle of June, excuse me, now running to an all-time high. The sector performance here is really quite strong to quite strong today. Only 3 of the 25 are in the red. Real estate is down by 0.12%. IYR, that's the weakest sector ETF. That's nothing. XLP, consumer staples, that's fine, being a weak one on a day where you have SMH. It's charging higher, up 0.73%. But that's not even the most impressive name on the board. I'm more interested in what's happening with the regional banks here. The regional banks are sitting at multi-week highs now. This chart's a bit of a mess. Let's just make a small adjustment and clean this up. It looks like there's somewhat of a ceiling here, right around 60 in KRE. But regional banks may be breaking their downtrend finally, and the Russell has been lagging for a long time. So if regional banks are up, semis are breaking out to new monthly, new quarterly highs, returning to the highest levels that they've seen since last summer. It's just going to be really difficult for bears to get something going in the short term, right? Ilya, if I'm thinking about this as a bear, my point of interest is not in what's happening today or tomorrow, but in the fact that volatility is getting pushed down across the curve the further you go out in time. And if I wanted to express a bearish point of view, I could do so a little bit more cheaply than I could have otherwise. And it wouldn't be through something like selling a call spread up here, although given how the market is in a low volume, low vol float, you could try to do so if you get the timing right, where if you think it's going to go up like 0.4, 0.5, 0.6% a day, whatever, just go out deep enough. But the play may be to look for some downside protection here. There may be some complacency in this market. Mm-hmm. And before I go into this further, if only to expressly articulate the headline that I shared with you yesterday, and I shared this on Futures Power Hour today, which I don't know if people saw this, but it's worth reading in full for those that aren't the audio. They're They're visual, excuse me. They're not audio. Let me read this out loud. A footwear startup is teaming up with 2 space companies to design a shoe in orbit as part of a mission to make artificial intelligence and blockchain less expensive and more eco-friendly than it is on Earth. Orbit's Edge, a company that supports AI and blockchain applications, and Copernic Space, which offers digital marketplaces for space assets, plan to send a solar and battery-powered satellite to space equipped with a computer that will use AI automation to produce a shoe design.
They have all the words in there.
Scintilla brand. The mission is expected to launch on a SpaceX Falcon 9 rocket in early 2026. I have no idea what I just said.
I mean, this is
came out of my mouth.
This is the pets.com Super Bowl ad of stories. I mean, this is the kind of thing you read and you go, wow, remember how Polaroid decided that they needed crypto in their name and their stock actually did bounce no matter how ridiculous of a thing that is? Yeah, there we go. We're designing AI and crypto shoes in space. This is ridiculous, obviously, and is emblematic of the kind of excess of risk appetite that you might be worried about in an environment where this is the year, next year, when you refi all the COVID debt that companies accumulated at basically no interest. The Fed doesn't want to cut rates. The U.S. economy has slowed meaningfully since last year and is the only one that's growing of consequence. Yes, let's design a shoe in space. This is the kind of thing that happens at sentiment tops.
It feels like it, doesn't it?
Yes.
Like Long Island Blockchain Corp.
Can we get an Economist cover? I'd like an Economist cover saying like, la-di-da, all is well. Can we do that? Somebody, should I start to do to the managing editor of The Economist what you do to the Ayatollah and just start to troll her on Twitter?
Well, which, by the way, I just have to send out like a heartfelt appreciation. I did get a direct message last night with someone sharing their trolling of the Ayatollah with me over DMs.
It's a community now.
You know, Team America. Okay. We were talking about a potential bearish position in the S&P 500 today on Futures Power Hour. There are really 2 ways to articulate this view. You could, of course, do the out of the money thing where you go to like the 20 delta. We'll look at, say, like long the 25 delta, short the 20 delta. It's about 100 points wide here. It's a 24% probability of profit, high convexity, basically 6-to-1 on the risk to reward. But what Jamal was kicking around here as just an idea is if we go over to a long put spread that's already in the money, and it gives you basically a coin flip probability of profit, even though the max profit to max loss is tilted in your favor, basically 3-2. Volatility is cheap right now is my point, okay? And this market does feel complacent for a variety of reasons. My own outlook here, not that it's been accurate this year, because having just seen the tastylive SPX predictions by quarter, mine was 6,300 for Q1, 6,000 for Q2, 6,300 for Q3, 6,850 or something for Q4. Although, again, I would push back and say at the start of this week, the S&P 500 was at 6,000. So with a week left in the quarter, it was pretty darn close. But I see this as a market that is going to hit that roadblock in August with those China tariffs, right? We have a White House comment today. Carolyn Leavitt, the press secretary, says that the July 9th deadline is not critical. We're not looking to extend it, they also said, but it's also not critical. It's because you can't have a world in which you have lower tariff rates on China than you do on all your allies and friends. It just doesn't make any sense. It's illogical. So July 9th isn't anything, but August 12th is. And looking at some option plays with relatively cheap vol on the other side of August 9th for a brief window of market panic, perhaps, as the summer goes into its second half when liquidity drains and more experienced traders go on vacation to Ibiza or the Hamptons or the Ozarks, wherever. Okay, the junior traders tend to panic. I think that if you're going to be bearish right now, not that I am in particular, because I want to chase this high of being a dumb bull that just buys out of money the calls and watches them print. I missed it so much, Ilya. This needs to be now like risk management, okay? Like, what are we doing to reduce our beta weighted deltas if we're running this market up higher? How can we position so that we're protected from some downside? How can I stay on the bull train with also keeping something in my pocket that if this goes sideways, I at least can get out relatively cleaner? And the cost of that insurance is pretty cheap. So I think this is the primary consideration right now. It's a bull market. We're running to the upside. I'm staying on as long as possible. I want to see 23K print. That's where my long calls are currently situated. But once we start to get up there, looking back to like 22,000, 21,500 NQ as some safety, I don't think it can hurt us.
It doesn't look like you have a situation here that is going to look for intricate catalysts or kind of high-minded ideas. This thing is either going to hit a sentiment extreme or it isn't. And it's probably going to have to be something very obvious or, as markets often do, nothing at all, where you just run out of reasons to go higher because everything is in the price and nothing else good is obviously in the speculative window.
Thomas, what's standing in the way of this market? Tomorrow we have PCE. Friday, tomorrow feels like a day to go golfing for most people. End of quarters Monday, non-farm payrolls next Thursday. Thomas, do you care about the non-farm payrolls report next week? Is this something the market is particularly worried about, in your view?
I do, and I think, volume is going to continue to be light tomorrow. I wouldn't expect it just to bounce back on a Friday. So I think people are going to come back next week. We got the NFP a day early for the holiday. So kind of a condensed trading week. On one hand, there's a lot of people away. On the other hand, it's condensed from 5 into 4 days. So perhaps, we could get normal volumes or it could continue to be light. But the reason I was waiting to get long is I was waiting for some catalyst when it's really just a confluence of factors that have been holding the market back that have now cleared, right? So like Ilya said, we have to hit a sentiment extreme. And until the NFP, we really don't have anything that could come through where it's going to really unhinge this rally. So on one hand, I want to chase because the price action is telling us, we're going higher. On the other hand, I feel like I'm already a little late. And when I get in when I'm a little late and trying to chase, it's worked against me a few times. So for right now, I'm waiting. But next week, I think I'll have to pick a strategy to play this out for the NFP.
Do you think the Fed cares about next week's NFP, Ilya? I know that we've heard from Bowman, from Waller, and now today from San Francisco Fed President Mary Daly, that a rate cut may be appropriate and will be something that's discussed in July. She thinks that September is still going to be when the Fed cuts. She says in the fall. Okay, so I guess September, or was it an October 30th meeting this year? It's late October again. Whatever the timing of the cadence is, it seems like her mind is that they're getting a cut in the fall in September. But July is not going to be a meeting where they don't even entertain it. So does non-farm payrolls next week make... Rather, let me rephrase this a different way. Isn't the best outcome for bulls right now for non-farm payrolls not to matter next week? Because if it does matter, it means that the July needs to think about a July cut?
Well, so there's a couple threads at work here. First off, the markets think that the odds of a July cut are more meaningful than policymakers seem to have hinted. So we're looking at a 20.1% chance of a cut in July. That's not nothing. And it's certainly up meaningful ways from 12.5% a week ago. And let's note, a week ago was the Fed meeting. So in the immediate aftermath. Right here we are on Thursday. Exactly 1 week ago is the Thursday after the late afternoon FOMC on the 18th on Wednesday. So the markets heard the Fed. They went right. So you don't want to cut, and you're not sure what to do, and you think you have all the time in the world. Yeah, you're likelier to cut in July. And in that period, since they heard the Fed, they've built out all kinds more easing into 2026. The Fed said 25 basis points in their SEP. The market said, right, sure, 62 basis points.
I mean, we've added basically 40-ish basis points to the rate cuts by the end of next year in just the past 3 weeks.
Yeah.
We've almost added 2 cuts to next year's calendar in 3 weeks.
So the market, so there you go. The markets they're not just saying that, oh, you're behind the ball. They're saying, no, it's happening. And frankly, you're likely to move both sooner and later in a much more dovish way than you're suggesting. So will the markets care about NFP? Well, it probably depends on what the number gives us, but NFP has been so muddy with the revisions that unless the number is completely unmistakable, it's very difficult to hang your hat on what comes out, and you really have to focus on the jobless rate and whether you finally get north of 4.2%. Thomas was mentioning earlier, jobless claims, not terrible today, but looking at the 4-week average, this past reading is a bit of a step down, but it's within a hair of last week's result, which was a 2-year high. So it's not like the labor market isn't deteriorating. The average NFP revision so far, the running 12-month average, is down almost 17,000 on a given month. In the latest numbers, the 2-month revision was 58,000, lower 48,000 before that, and on it goes. These numbers have been routinely revised weaker, and the average for the 2-month revision has been negative going all the way back to January 2023. So let's see what these numbers give us. Last time, the expectation was 130. La-di-da. We got 139, so only a touch better with a 58K downside revision on the preceding 2 months. Was it a good report? You tell me. It was a little bit better at the headline and much worse for overall job creation. So it's a curious thing that we're looking at here, but the markets clearly seem much more interested in what they think. Bonds are rising, dollar is getting smacked, more expectations for rate cuts are entering than what policymakers are saying. I don't think the markets care very deeply here about what the Fed is saying. I think the biggest risk for markets is if NFP is really strong and it turns out they're the ones that are offsides. The best case may be actually a relatively soggy number as long as it's not catastrophe bad, where the Fed might be shown to be very, very behind the ball, but that seems very unlikely just by the nature of kind of the spread of probabilities. A really out there tail risk result is inherently unlikely. So you're looking at probably something middling, and the markets would like something softer. Because if they get softer, they get validated. The Fed looks like it's wrong, and then maybe July really is live. Or at the very least, maybe the Fed says all the things that they need to say. so that by the time we get primed for Jackson Hole, there's a big fancy Powell speech that sets everybody up, and in September maybe we go big again. And maybe it turns out that we get a 50 basis point cut again because
I've been saying that
we should have got in July, baby. What were we doing? So
that's the funniest outcome. Like last year was Powell declaring inflation being dead. That's what 50 basis point meant, right?
Yeah.
Trump didn't like it because it was a sign before the election that the big story before the election was over, and obviously it wasn't, but that's how it was spun. So 50 basis points in September here, how would that be spun? Would that be...
We should have got in July.
We should have got in July, and the economy is probably weaker. So but if the data holds up, right, Thomas, isn't this kind of like the dream scenario that you're seeing for bulls here in terms of rate cut pricing? All of the fears, the bricks in the wall of worry, they haven't materialized. And so the market's like, well, they're going to materialize, so we're going to need more cuts in the future. But in the meantime, the market's like, well, we're discounting cheaper money, at least. And so we can party until the damage comes. It's not that the market really loves the Fed cuts, needs them, but like, hey, we have more easing coming down the pipeline. Who cares? We can run this thing up.
Yeah, it's something to underpin the market, to underpin sentiment. So, I mean, the initial jobless claims wasn't bad, but if you look at the continuing jobless claims, those were the highest since late 2021.
Yeah.
So it's kind of a good scenario if you want more cutting, because it's saying that companies, they're laying off, but they're doing it at a very steady rate, and they're not hiring that much. So people are getting forced out of the job market. It's taking them longer to find jobs. So that's not a catastrophe. So if the numbers come in slightly weaker, those July rate cut odds all of a sudden go from perhaps 20 to up to 40, 50. And then the market is hanging its hat on getting a July rate cut and then a September rate cut. But yeah, you're right. If the September comes in 50, of course a 50 says we made a mistake somewhere. Because otherwise it's going to be a 25 like they've been projecting. So I agree with Ilya. The best case scenario is probably slightly under expectations or at expectations.
We turn to the halfway mark of the show. We've been talking about equities here. Bonds had a pretty good day too, guys. It's after hours, technically, or after the market is marked to close. But we see that ZB here is now at 115 and 2 ticks. It's currently sitting at the highest level that we've seen since the start of May when it bumped up into here. It's been a level where the market's been struggling to break through in recent months. Ilya, it feels like if you're going to be a bond bull, you kind of have everything going for you. Oil prices have come off, so the inflation scare is gone. And also, oil being too high is disruptive to growth. So,
that's
right, at least we have that intact. We turn around and think about what's going on with the Fed. They're not cutting in the short term, despite a lot of pressure to do so. And two things I think actually, two ideas that we've shared here on Overtime in recent weeks. One, a Fed that's refusing to cut will help the bond market stabilize and move up because it's not reflationary. Bonds are up 4 or 5 points over the course of that idea. It's been slow and hasn't been great. Like, it's not moving fast, but it's working. And the other one was that equity traders would be forced to chase this market through the end of the quarter because of positioning at the start of April, because everyone just being off sides, people continuing to short the market on the way up. And then that's, of course, underpinned by the rationale. You can't lose money in a bull market. If someone's giving you money to trade for them and you underperform SPY, you're not justifying your job. So
it's not that you can't. You can. You're just not allowed to.
Right. Well, so bonds, though, are kind of, Tuesday you said if the bond trade's going to work, it's going to work slowly because bonds shouldn't move quickly.
You want it to work slowly.
Why is that? Can you just reiterate?
You don't want bonds to be doing crazy things. You don't want for the markets to be having volatile opinions about the long-term faith and credit of the world's largest economy. We saw what that looked like in April. Those are not happy times. You do not want, if you're any kind of any kind of optimist about anything, frankly, because the Treasury bond really is sort of the underpinning of the global economy, as is the U.S. dollar. This is the cash choice of commerce when it comes to the dollar. It's the benchmark risk-free asset for global finance writ large when it's the U.S. Treasury bond. So you don't want for there to be chaos here. And sure enough, no chaos. We're just slowly crawling higher. And I've been long the long end for a while. That's the part of my portfolio that is helping to paper over some of my sins elsewhere. Most recently, I extended duration about 10 days ago. I've still got 50 days in these TLT call spreads that I have on. So I've given myself lots and lots of duration. In fact, that's been my MO basically since the beginning of the year, to stay small with more duration than usual, to kind of dilute my exposure to directional delta and really take time with these markets because they're very choppy. The only place I haven't done that is in FX, where I've just been outright trading the micro futures and spot. And frankly, that's been my bread and butter all year. So looking at the bonds here, they're doing the thing you want them to do. If you're bullish, what you want is an orderly, steady stair step. That's exactly what you've been seeing since basically the second half of May. On we go.
Thomas, you have any strong feelings on rates right now? Notes are trading at their highest level since the start of May. We can look at this from the yield perspective. 10-year yield is now down to 4.239%. That's good news.
Yeah, I got long a call spread in ZN. I still have to get that on the follow page for the 57 days out, so I gave myself plenty of time at the 112.5, 113. But yeah, like Ilya said, nice and steady. You know, this is definitely a bull market that we're in for the trend right now. You know, with the time I gave myself, I'm willing to weather any pullbacks, and you know, pretty much what I'd expect to see if we pull back is something to like the 21-day EMA 111.075, maybe somewhere around there, which you have, you know, one of your support resistance lines right there pretty much. So that's kind of what I'm thinking. I didn't want to wait for a pullback to get in here just because the time I have is, I feel fine with that. But I think, you know, the view now is rates are going to come down. You know, it would take something pretty big to throw off the calculus for where rates are going. And if that's going to happen, you'd see a lot of dysfunction elsewhere in the market too. So I just want to get some long exposure here. That's my only position in bonds for now.
I think I might make an adjustment to my directionally neutral positioning in notes over the coming days, if only because we're starting to get away from the midpoints of the trading range. I say I might because I still have fairly decent strikes to make this work. Given the volatility when this trade was put on, I was able to sell the guts basically at the extremes for the year, 109, 114, right? I still have that correct here. 109, 113, and buy back at 108, 114. So unless we go down to the low in February or to the high here from the start of April in the next 7 trading days, which I guess is possible, but I think that directionally neutral continues to work. The only question that I find myself asking these days, it's a 16.4 IVR. I guess that's richer than what we're seeing in ES or in Q, but there's just not a lot of vol in bonds. And I know that when vol gets this low in notes and bonds, people tend to look elsewhere. What's the trade here, though, Ilya, for the next few months? I think you and I were on board with the chop, and the chop hasn't stopped. Mm-hmm. But is the chop still the play? if we have to start having conversations about, wouldn't it be funny if the Fed had a cut by 50 basis points because things are so crappy and they're running so far behind? Is that a good thing for the bond market?
I mean, I'm perfectly happy to stay long as this continues to kind of begrudgingly work. And if the Fed throws us a little bit of a bone here with a level change in rates, yeah, okay, if you front load a bunch of cuts, then maybe you get to a place where inside of a 2-year window, you get fewer cuts downwind because the Fed has finally jumped. You kind of saw this with what happened with the 50 basis point cut in September last year, right? The markets were yelling at the Fed from mid-April until that mid-September cut. You have to cut. You have to cut. You're going to miss the boat. You're going to miss the boat. You got to go. You got to go. And the Fed was resisting and resisting and resisting. And all through that resistance, bonds were rallying. The dollar was getting clobbered across the board because the market were saying, okay, so you're not going. That means you have to do more later. It'll be more dovish. It'll be more dovish. Then when the Fed finally goes and they go 100 basis points this year, 50 up front, 2 more meetings left. You do the math when those rate cuts are coming. We're locked in. And the market goes, whoa, hold on now. That's a little bearish. That's not what we said. This is a little too extreme. You've overshot. And then bonds sell off and the dollar rallies into the end of the year. So if the Fed does 50 basis points in September, the big question will be, do the markets think that's too much?
Mm.
What does it look like in relative terms? Right now, the Fed is baking in 50 basis points for the year. So unless that calculus changes, and I suppose we'll have to watch what they do in July and definitely watch what they say at Jackson Hole, because that'll be a kind of lens framing exercise. Then we'll see. Last year, it was very clear. The Fed came out at Jackson Hole. They gave the tip of the hat in the dovish direction, and then there they go in September. If this year they reframe the lens again at Jackson Hole, and it's dovish, we'll see. Because right now, the markets are basically in line with what the Fed forecast is, at least for this year. It's 50 basis points. So, and frankly, a little bit north of that today. It's starting to creep. It's approaching 60. So, we'll see. We'll see where the market is set after Jackson Hole, when it's time to go in September. But if the market judges that a 50 basis point cut is appropriate, and they seem to be angling that way here, the ongoing disappointments in U.S. economic data over the past month, today's durable goods jump, and it was a big jump, notwithstanding, the overall sort of vibe in U.S. economic data has been generally negative for about a month. This would give you a sense that if the market thinks that 50 basis points is right, bonds keep going higher. It's contextual. It's not automatic.
Well, that puts the dollar in an odd position here, guys. I know the sentiment's cooked, and I just took off a position today. I tried to short the euro, and it had a nice few days.
I've been taking them off since the beginning of the week. This is not working.
It seems normal to me because it's, okay, sure, all of this wasn't normal when we were going through the whole tariff nonsense. But since we reset the table, the dollar has basically been following the bond market. Lower yields, weaker dollar. Lower yields, weaker dollar, right? And so I don't know if we can call that a surprise. Technically, this thick white line here is your 50 SMA. We hit it in February. We hit it here again in May. We fail up against it earlier this week. That engulfing bar brought us back down below the 1 month and the 1 week as well. So the bearish momentum is clearly here still. Although I took a small loss in the euro position, again, it was put in place with enough duration so that if we breached 117, be able to get out at a small loss, and it was like $275. We go over to 6J, and this is where I am now starting to try to lay out capital to get short the yen. This is still a currency that has a 2.93 z-score in terms of speculative positioning over the past 20 years. It is outrageously crowded right now. And we've seen it more crowded at the start of April and May. But never before in its history has it been this long. Okay, if you were to compare positioning in the market today to literally any other period of time prior to the start of 2025, that would be the highest, biggest net long position you've seen in the yen. Period, end of story. So I want to fade this. I don't want to be involved in a long yen trade at the moment. I want to be involved in a short yen trade. So right now, I'm going to put this back on if it doesn't get filled. I'm trying to start to buy into the 68-67 put spread with 71 days to expiration. Basically looking for a return down towards these range lows that we saw in April, here in May, and again, just a few days ago in June. The yen to me is cooked. It doesn't have a reason to be up here. We got the bounce that I was looking for. I wanted the bounce earlier this week. We mentioned get up to like 0070 and we could start to look bearish again. It happened today. So I'm going to poke around on long dollar in a very narrow sense because of a crowded market.
Yeah, I mean, I thought that we were starting to get a little bit crazy here in the dollar, and I actually flipped over my shorts into small long exposure Friday last week, thinking, okay, we've probably hit something here. There's a key technical level. The risk reward is good. The trade is terribly crowded. Let me take a step back. Let's turn these cards over. The Fed doesn't want to cut. They've just said so loudly. We had Powell testimony this week where he wasn't going to say anything different, and he didn't. And it hasn't worked. Probably the most dramatic places I'm looking at isn't the yen. The yen has been kind of consolidating in what's increasingly a kind of triangle-looking something. But just look at the euro. Look at the pound. They are scorching. And
yeah, that uptrend the pound was breaking a few weeks ago, it's technically back above it now.
That's the thing. So it started to maybe crack, which is what got me short. And no. That's not what's going on here. Even the Canadian dollar found a little life here against all odds. But I mean, look at the euro as your kind of benchmark for the most liquid US dollar counterpart. I mean, the dollar index is essentially just the euro upside down. This is unmistakable. This is every opportunity for a double top and then a clear,
never happened.
Just very, very, very obvious first page of a technical analysis textbook bullish breakout. Like obvious resistance, test, hot knife through butter.
Well, I mean, that was the risk outline when we took the trade, right? It could be an ascending triangle still.
That's right.
But I guess, Thomas, given the positioning that we know, where people are far too long the yen and the sentiment on the dollar is still very bearish, would you take multiple cracks at trying to get long the dollar here, even if you have a few trades that miss out? Do you find the risk to reward appealing enough?
Well, last week I got out of my short put spread on the yen, pretty much at the bottom, and then I got into a short call spread on the euro, and so I've been burnt on both sides now. So I'm surprised the dollar's gone this low. So one of the reasons I got that trade on the yen is because you told me last week that the positioning was so extreme, and I agree that that kind of trade can't last.
So we're saying
it's your fault.
Like it.
Yeah.
Well, okay.
We're saying blame Chris. Good.
Yes.
I'm on board with this.
Fair. I'll wear that.
Yeah, and then last week I tried to sell the call spread on the euro for this double top, and of course that hasn't worked out either. after being long the euro all year. So I think, the underlying reason is the dollar's weakened so much. I'm wondering for the euro, are growth expectations lagging what the market thinks for Europe right now with the defense spending and everything else? Is it going to be a story of Europe has better than expected economic growth over the next few years? Are we starting to price that in now? Are people trying to get ahead of that? Or is it just the dollar is, continues to weaken for, it surprised me how much it's weakened. So, it's calling, do you try to call a bottom now? And I'm not going to do that after 2 bad trades within the last week.
Sure.
So right now I'm going to stay, I'm going to keep my euro position on right now and hope for a pullback to take that off at either, at unsure, a small loss. But I'm going to step back and reassess the currency market with not being able to really see what the dollar is doing here.
Ilya, one thing that's really important to me is showing signs of personal growth. I don't often do it, but a year ago, you and I were trying to get long the yen because of positioning. Everyone and their mother was short the yen.
Yeah.
And it felt like every 45 in, 21 day out, I would buy some yen calls, and then I'd watch them evaporate into nothing.
Oh, we got cooked.
Well, it's very generous of you to throw yourself into the pot with me, because
I was long the yen for similar reasons, although in fairness, I didn't stick around as long.
But July comes around and I say, I've been doing this for 6 months. Maybe the positioning argument isn't going to hold up, but of course positioning is like a glacier. It takes time. It just doesn't happen. People don't just liquidate everything all at once. And so I stopped buying the yen. And then last July, the yen decided to do, what did the yen do last July? Oh yeah, it did this. It went straight vertical after pushing on that string. It was going down, buying calls, just like 100 pips out of the money every time.
I managed to catch a little bit of
you
it.
caught it
On the second leg of it.
That's why I'm saying, like, don't throw yourself in the pot with me. And the point I'm getting at is that there was a macro, a positioning, not a short-term view that was worked out. Like, this is going to break at some point. I just need to stay solvent before the market snaps to being rational. And I could have been. And I just got tired of losing little bits of money. And had I just stayed with that, okay, this positioning is going to break at some point, I just have to be patient here, and I'll catch a wave. I was right. I just fumbled the ball. And so it feels like this is the same thing, but on the other end right now for the yen, where we have this extreme positioning. It's sitting around, being short the yen. You've been getting chopped up. You've been getting eaten up for the past 6 weeks, 2 months, right? You haven't been able to get that downside traction. And I just can't throw in the towel this time, because I need to show that personal growth where I understand that if it's a good idea, I just need to stay solvent long enough and stay small enough so when it does hit, I don't, if I'm wrong, I don't get wiped out. And I didn't last year. I just got bored. That's not a good excuse. That's not staying mechanical. It's not staying within the confines of the trade idea. Thomas, I understand why you're not going to call a bottom here. But a year ago to this day, I was on Overtime complaining to Ilya that I was sick and tired of trying to be long the yen, and then it spit in my face immediately the week after. I just can't do that to myself again. Mentally. It's not going to be good for my mental health. Okay. I'd rather actually lose
Michael
money.
Burry in 2007. You're not wrong, but you're early.
Maybe I'm early. Maybe that's it.
This is the perpetual thing that I'm always talking about when I am entering these tiny little pinprick shorts against the stock market that I don't believe in. It's because if the market is telling you something,
sorry.
Technically, it had already fallen by the time I left. Technically. When I take these little stabs, it's because the price action has created some kind of risk-reward opportunity that's attractive. And maybe it's right and maybe it's wrong, but I'm going to structure it in a way where it's asymmetric enough that if I lose a little, and I'm okay losing a little multiple times. If the idea seems legit, if the price action tells you it's go time, it's why I didn't stick around in the yen as long as you did and then got back in. I was waiting for the price action to show me. And I'll take little stabs like that, and I'm okay with losing on quite a few of them, as long as one or two really pay. And that's sort of the thing you have to do, I think, if you're going to take a macro perspective on markets, because timing macro stuff is a fool's errand. You never know. So if you have some kind of macro narrative and you think it's right and you see evidence to suggest it, when the price action lets you, take a stab. You're probably going to be wrong a few times.
I always go back to the baseball analogy. If you're scalping, you're a slap hitter. You're just trying to get little singles all the time. If you're a macro trader, you're the slugger, right? Like, you're going to strike out a lot, but you're going to hit the home run every now and again. And like, it has the net expected value is positive. Like, you want the guy who strikes out a ton and hits dingers, because it's good for your lineup construction. You can't just have a guy who hits 300 and only gets singles. You're not going to get anyone around the bases. Thomas, I wanted to ask you a question before we end the show, because energy is back in focus. We called this out a few days ago after oil had its big 10% decline. Ilya, you and I were talking about exiting short deltas, flipping to directionally neutral, understanding that previous sell-offs of this nature, when you have 10% or more over the course of 2 days, you usually get a window where there's a little bit of a bounce back over the next day to week. Next day was historically right around 2%, the next week a little bit around 4%. So the fact that oil has stopped falling, so to speak, I don't think surprises anyone in this room. Thomas, you mentioned to me earlier today that you're surprised natural gas has fallen as far as it has. You and I both, I think, are in similarly structured trades where we've been selling put spreads down against like the 3.3, 3.4 level. How are you feeling about this now, given you've had a full day to digest the price action and really what's been a week of fairly aggressive selling in natural gas?
Yeah, I was feeling worse this morning, but we trimmed a lot of losses. So the EIA numbers came out today. I think it was a 99 billion cubic feet build. The 5-year average is right around 78 for this time of year. So we're building more than expected, and we've done that for a couple weeks. So I'm still keeping my short put spread on at 3.25, 3.3. And I think that aligns with some technical levels that, are buy points in the market. And kind of right today, we saw buying when we got down near 3.4, you saw the buying start. So I'm going to stay in it. I was thinking about taking my the call spread side off, because I have a short call spread on as well for 32 days out. So I'm going to take that off in the next couple days here, because we're starting to run out of time. I'll leave the put spread on until around 24 days. So I'll wait until next week to take that off. And I'm expecting, of course, that 3.4 level. That's all I'm looking for it to hold. If we drop below 3.4, I'll take that short put spread off and reassess. If the 3.4 breaks 3.2, 3.0, we could drop under there, because there's some room that we haven't traded at for quite a while. So 3.4 is kind of like the line in the sand right now. It's been really hot the past week. The U.S. has been in a heat wave.
Has it?
That should have, you know more than anyone. That should have, reduced the stocks more than expected. But at the same time, you had wind and you had solar displacing a lot of natural gas demand. So it was sunny and windy everywhere that it was warm last week. So you kind of got a canceling out of that, the expected effect that you would see in natural gas, which is really, really hot, a lot of demand, strong strong inventory or a less strong inventory build during the summer. That didn't happen. But the buying today at 3.4 is kind of encouraging. After 4 or 5 days of selling, I think if you want to get long here, I'm already long on that side. I wouldn't mind at all.
Yeah, come help us. Come help me and Thomas.
I got out of my oil short yesterday, and that's the only thing I'm doing in energy right here. This is one of the more confounding spaces. I'm not eager to jump in one way or another.
Well, with that, overtime is out of time. We'll be back in a little bit. Ilya's coming up next with macro money, so stick around after the break. I'll be back later today for the Price of Truth with Victor Jones. So see you in about an hour's time. Until then, though, for Thomas Westwater and Ilya Spivak, I've been Chris Vecchio. See you on the other side of a break. You're watching Tasty Live. Ilya Spivak with macro money up next.
See you there, everybody. Well, the markets continue to melt up, and it seems like they're doing so for no particularly good reason or with particularly strong volume. Nothing especially shocking on the calendar. No big new headlines from geopolitics or from the world of economics, at least over the past 24 hours. Nothing to really suggest that we ought to be screaming higher or not. But nevertheless, the markets take their cue, and we're approaching the year-to-date highs on the major stock indexes. The U.S. dollar is lower across the board, and the markets still seem to be building out expectations that the Fed is going to end up much more dovish than expected, even most importantly by the Fed officials themselves. So what is the backdrop for all of this, and can we sustain it? That's what we're going to task ourselves with trying to understand today on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live, and we get the opportunity to get a check-in on the overall global economy here as we prepare for a update on Chinese performance early next week. We have earlier this week seen the June PMI data set for the US and the Eurozone and many of the other major economies. China is always about a week late, and next week we begin to see what they have for us for June and start to put together a more complete picture of the global growth environment. So that's exactly what we're going to do here. Look at what this data might give us and consider how it might impact the overall backdrop. Now, of course, that isn't to say that we are going to get a direct read-through from this data into the price action. It'll depend if the price action decides that it wants to care. But as ever, it is a game of relative value here and a game of watching and seeing whether assets make sense in their valuation relative to the back story and not just in isolation. So this will be a backstory shaping set of numbers and a back story shaping kind of a conversation where we'll try to figure out if the global economy really is in as good a shape as these buoyant financial markets seem to suggest. So let's begin here with what is expected. These are going to be the official PMI numbers from China. As with the US, there's two sets. In the US, we have the kind of global standard, the PMI numbers from S&P Global, and we have the Institute of Supply Management that creates a parallel survey. They pull a different set of businesses, but produce a similar thing. In China, it's somewhat similar, where you have the official numbers here from the China Federation of Logistics and Purchasing, CFLP. That's in conjunction with the National Bureau of Statistics. This is the government's PMI survey. It's tilted more so to large enterprises and state-owned enterprises, or SOEs. There's a parallel set, which we'll take a look at in just a second. That's from S&P Global in conjunction with Caixin. So we'll compare them and see what the story is. The picture here for China in these numbers clearly seems to be of ongoing standstill. So this was the reopening pop here when China finally jettisoned its zero COVID policies and reopened the economy. You can see there was a bit of a surge here. Manufacturing never really got off the ground in a meaningful way, but certainly letting people out from lockdowns was a boon for services. And so there was this services surge right here that lifted the overall economy. Since we're going to be talking about these PMIs a lot, let's just, for the uninitiated, very quickly explain how these numbers work. This is a diffusion index, and so the way that this is constructed is it's tracking the services and manufacturing sector's activity growth and the pace of that growth. 50 is neutral, that is neither growth nor contraction. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the pace of growth. The further you go below 50, the faster the pace of contraction. And so clearly here we can see, following on from the manufacturing and service sector lines here, the story is of anemic manufacturing for quite some time, but then you get that pop at the reopening in services that fizzles relatively quickly, and you settle into this multi-year standstill where you now have a situation, looking at these forecasts again, where you're hugging that 50 line. So basically going back to mid-2023 and through to now, China's economy is going virtually nowhere. Here's a composite reading from that rival survey, the Caixin and S&P Global survey. And here you see it's been a little bit zestier a year back than were the official numbers, a little bit higher on these readings. But as you work your way through the past 12 months, the story is increasingly negative and increasingly converging on what the official numbers are showing, so much so that the May number was actually worse than the official figures and gave us a slip underneath 50. And when you look at the composite internals, these are those Caixin services and manufacturing numbers. You can see services, since that pop in early 2023, they've flatlined, much as the official numbers would suggest. You saw that right here. But we can see that in at least these numbers in May, that really overall reading. And so when we consider then what comes next, we sort of see both of these things pointing in this kind of stagnant direction. Now, this is not entirely new or unusual given recent months, and really sort of echoes, this is why we look at PMI numbers, incidentally, it echoes in the most sort of hard data you might imagine, GDP statistics. And this is, of course, the story now for 8 consecutive quarters. Speaking to the issues in the world's second largest economy. Here's that pop at the open of 2023. Since then, we can see the economy has done virtually nothing. The pace has held relatively steady and dependably sub 3% for growth, which by China's standards, we can see here, the pre-COVID levels are meaningfully stronger. But looking at what we're seeing here, the biggest issue really is that when you compare nominal and real GDP, you find that real GDP for the past 8 quarters has been growing faster than nominal. And this is the spread. You can see that when you take the difference between nominal and real GDP, you get a negative number now. Whereas you can clearly see before that, the norm was substantially pointed in the opposite direction. So when you had Chinese growth here, and it was in real terms hovering just above 6%, you're now at very similar levels here, albeit you're hovering a little bit under 6%, but the makeup of the growth is vastly different. And what this speaks to, because of course, what is nominal GDP? It is the sum of the value of all the goods and services in a country, and it doesn't factor out the impact of inflation. When you add up these things, these are sort of nominal prices without being discounted for the prices themselves going up. And so oftentimes you can get an overstated version of demand, for example, here in nominal numbers because of inflation. So you take inflation out to get a real sense of growth. Now, if real growth, that is nominal minus inflation, is running above nominal itself, then you're discounting nominal by a negative number. And that's what you're seeing here. Economy-wide deflation for 8 consecutive quarters. Now, this is, of course, horrible news for any economy, because what it essentially suggests is vast overcapacity relative to demand. So lots and lots and lots of supply, much more than demand is able to absorb. And so the entire economy is essentially on discount. The price of things is getting marked down and in economy-wide terms falling, essentially the price of GDP falling, because there's not demand to absorb all of that. And essentially what you get is an economy that for basically 2 years here has operated without demand growth. So needless to say, what we're seeing in the PMIs very much anticipates this state of affairs continuing going forward. And indeed, some of the higher frequency data we've seen recently are a case in point. At the top here, we have the latest inflation data. We can see the PPI index dependably below zero, showing us that wholesale inflation has been falling, going all the way back to COVID lockdown days here, mid-2022-ish, into the second half of the year. We flip from positive to negative and stay there. Headline consumer prices hugging zero, and have been hugging zero potentially since early 2023. The story on the external sector, hardly encouraging. There's been a little bit more pep on the export side, arguably around the front running of tariffs and U.S. demand being especially robust here at the start of the year as we get that rebuild of inventories that we saw with such sharp relief in first quarter U.S. GDP numbers. But domestic demand going the opposite direction. And that's not a happy thing when you consider that you've had anemic manufacturing for quite a while here. A short pop is not especially helpful. What you really need is for the service sector to come back to life, for domestic demand to start to take up some of this slack. And these fading import numbers, they don't suggest that that's the direction that we're heading. In fact, this is looking increasingly negative here. And the pop in exports, in fact, over the past 2 months, seems to be fading, where the front running is running its course, and we're starting to recede back. There's still a very significant pool of capital out from China. We can see here foreign direct investment still negative to the tune of double digits, but of course it has improved significantly from being worse than a 30% drop there by mid-2024. Capital is still coming out of China in droves, but the pace has, of course, improved and was eventually going to improve even just in statistical terms as you adjust year-on-year calculations for basing them from lower levels. So eventually this pace was going to normalize, and frankly, that we're in 8 consecutive quarters and of deflation, and we're only normalized to a decline of worse than 10% year on year in the latest data, still quite discouraging. Where you do see a slight sliver of positivity is in whether China's raft of stimulus measures might finally be showing a little bit of life. So we can see here, this is the Bloomberg Credit Impulse Index for China. It measures the share of new loans in GDP. Of course, China has been attempting to lay out oodles of new money to try to incentivize demand. They've cut bank reserve ratios, they've cut economy-wide interest rates, they've announced all kinds of schemes for debt relief for municipalities, for giving money to consumers for all kinds of various things, be they lower mortgage rates or incentives to buy stock or incentives to trade in old appliances for new ones at very lucrative terms. All kinds of cheap money designed to get the economy to finally start to show some life. And now that we see for the past 2 months a slight sliver of positive year-on-year growth in this index, we get the sense that, okay, maybe finally new loans are starting to perk up. Problem is that people don't seem to be wanting to spend the money. This is a view that we've been looking at here for quite a while. This is the difference between China's value of demand deposits, that is to say, those things that are there to be used almost as a checking account, so something that's earmarked for consumption now, and the difference between that and time deposits. That is to say, those things that are looking at savings, CD equivalents, and things like this for the overall economy. And so you look here, and what you see is a very significant disparity that seems to be opening up here. And the disparity really continues to grow and grow and grow here. And for the overall kind of level here, this is as high as the data available goes back. So what is this telling us? Well, maybe, in fact, yes, there are more new loans at these more lucrative terms. Maybe people are finally starting to believe somewhat that this money is really and truly available. But what they're not doing is spending it. What they're doing is increasingly sticking it in here, in savings. And so that's how you get fading imports. That's how you get still an economy that doesn't want to do much of anything growth-wise. Because it seems like consumers are not confident that growth will come back. They're not confident that the right things are being done by officials in Beijing to really kickstart this thing. They're just stuffing money under the proverbial mattress. They're taking all of this new money and they're sticking it in savings. They're not going out and spending it. And that suggests that, yes, maybe we have a little bit of hope for stimulus starting to work a bit because there's uptake of these new loans. But if the money doesn't get spent, well, we know all about that in the U.S., where we had tremendous easing in the wake of the global financial crisis, and then consumers used the money to rebuild their balance sheets and didn't spend it. And so the recovery was very, very sluggish and prolonged from the recession in 08-09 until we started to see some green shoots a little bit going into 2014, 2015, 2016. This is not dissimilar in the sense that, yes, there is cheap money. Yes, people are taking the cheap money, but they're not doing anything with it that might generate growth. The problem, of course, is that China is the second largest of the main engines of global economic output, along with the US and the Eurozone, and the story continues to be imbalanced, where the US is the only one holding up the entire situation, not just because of its share, but because of the way that it's performed. Consider also that the 42% in the rest of world part of the pie here are mainly vendor economies that depend on buying from the large three in order to have demand of their own. Here were the numbers from the Eurozone this week. Standstill, hugging 50. As we can see, this is not unusual. They've been averaging just a hair above 50 for the past 12 months. That, of course, is in contrast with the US numbers, which are a level step lower from the very buoyant 3-year highs on growth that we saw last year, but more positive. And when we compare that with the overall picture, we can very clearly see where the imbalance lies. All of the second half of last year, it was China and the Eurozone at standstill, and the US powering ahead. The wedge has narrowed, but nevertheless, it is still the same story. Standstill in China, standstill in the Eurozone, and more modest but still positive growth in the US. That would be all well and good, except as we look at the way that US economic data is increasingly performing relative to forecasts, we can see that of the major economic engines and groupings here, it is clearly the US where data is underperforming, today's buoyant durable goods data notwithstanding. Emerging markets, relatively steady. Eurozone actually improving. The overall global economic data surprise index fading, suggesting that global data flow is cooling. That's clearly coming from the G10 space, of which the Eurozone is not the issue. Clearly, it is the US that's pulling the situation lower. And so, for the global economy as a whole, we are left with an ominous backstory. This is the only part that's working, and it's also the one that's deteriorating. This is already at standstill, and this will probably remain so when we get this PMI update next week. Now, will the markets care, and will they start to turn to a more risk-off direction on this basis? As ever, we'll have to watch the price action to see. But if something does occur to spook investors, the backdrop is certainly anything but cheery. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I'll be back with Chris for Futures Power Hour tomorrow. We'll also be covering for Tom and Tony on Last Call, so you'll see a bunch of us as a special case this week. I'm likewise on The Price of Truth with Victor Jones on Tuesdays, with him and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
What is going on, everybody, and welcome back to Risk and Reward with Gus and E. Got a lot going on this week. Market's still ripping to higher highs, so we got some things to talk about. Before we do that, Gus, how we doing, bro?
Doing well, hanging in. Yeah, we just keep gradually eking towards these all-time highs, just like you said. I mentioned on Tuesday that there was a lot of similarities to the COVID recovery going on right now, and I think that certainly still holds true. I actually have some interesting numbers in that front to bring up in a little bit. But yeah, feeling good. I'm still very long Delta, and so I continue to make good money when the market goes up. So I'm happy we can spy to 700. Let's do it. Why not?
Yeah. Hey, I mean, it seems like risk is easing a little bit more. I know tensions have been easing with the Iran and Israel war and those type of things. So, I mean, the market seems like it's feeling good so far, but things still feel eerie to me. Like sometimes we'll get consolidation, we'll get some aggressive pullbacks. It starts to feel a little eerie, but we're ripping all-time highs. I don't know. It's difficult to trade these levels, but at the same time, I'm like, is something brewing here? I feel like with Israel, Iran, and just other geopolitical things going on right now, I just wouldn't be surprised if we got any type of headlines that catch us off guard and are surprising, especially when everything feels good right now because we're at all-time highs. So that's been running through my mind.
It's funny, and that's one of the things that's been crossing my mind with the COVID recovery comparison as well, because as we were, coming out of that COVID dip in mid-2020 and approaching all-time highs, it seemed so logical that we would maybe get those all-time highs again, touch them, and then consolidate for a little while and chill out, because there was still so many reasons for there to be volatility and so much uncertainty and so much fear still happening in the world. But it just that fear and uncertainty that was present in the world did not, show up in the market. The market was not reflective of it at all. The market acted like there was no fear, and we were in a greed phase. And so I think, that we could be seeing something similar to that here, where even though all of the external and, news-driven things that we would usually pay attention to are screaming that this shouldn't be happening, we just keep pushing higher. And, I become more of a buyer of this theory every passing day.
No, I hear you completely. We're very familiar with this all-time high talks. I feel like we put in so many over the last few years, especially. But I mean, VIX has been really quiet, but Dr. Jim made a really good point yesterday. Even though the market's been rallying to the upside and it's a little down on the day again because we've been putting in new levels to the upside today, honestly, it's not as low as VIX could be. Like earlier in the year from last year, we were trading at lower levels on VIX than now, and we're putting in all-time highs. So maybe we're still due for a little bit of a pop in VIX, but hopefully that pop's not just to like 18 and then back down. But we haven't gotten a pop in VIX in some time either, and we're still trading at all-time highs. So another point there.
Yeah, Dr. Data and the wonderful research team shot over something this morning that showed that put buy volume is 19% higher than call buy volume right now, which I do think is something interesting. Perhaps something brewing there. Efficient market hypothesis suggesting things are going to move down, but it creates this. I don't know. It creates a very interesting and nuanced situation with the VIX. I feel like because if we. there's all this pressure coming in. I don't know. I think you hit the nail on the head saying that VIX is absolutely not as low as it could be. VIX is not, telling us the story that we are, absolutely through this and just cruising and chilling now. There is still more downside room there and some indication that we could possibly, see some volatility in the coming weeks.
Yeah, 100%. We'll see what we get. I mean, we'll dive into the platform here. I got on a few extra positions this week in line with a lot of this volatility at the highs that we've been getting. I don't know if you've been having any thoughts on crypto, but I did get some exposure over there. Crypto's been ripping all-time highs. Not as much crypto talk as I would have thought there would have been with crypto at these levels. But Bitcoin is not playing any games either. Gus, I don't know if you've been keeping an eye on crypto, but it's been booming. No doubt. It's been booming.
Yeah, that it has. There's lots of, this is just such a pro crypto administration. We just have one, regulation stripped off after the other, it seems, and we're getting it to be a lot more of a free market, and it allows for a lot of different things. Something that I saw the other day is that the name of the company is escaping me, but somebody is offering tokenized shares of SpaceX now because that's something that's doable under these new regulations. So
tokenized shares at SpaceX. Okay.
Yes, because SpaceX is not a publicly traded company. I don't know enough about the crypto and blockchain space to really dive into the weeds of it, but they're offering tokenized shares of SpaceX. There is an avenue now to get some actual equity, or at least synthetic equity of SpaceX going on, which I think is interesting. And crypto presents all kinds of opportunities in that regard. And events contracts also are
we can't just brush over that. That's a pretty big deal. I mean, I feel like that would even be a pretty big deal for other private companies in terms of letting shareholders within people that believe in the company and are help build it get access to that without being public and going public, like especially SpaceX being a leader in general in terms of innovation. I'm curious to see some of the logistics on that end that they apply with some of this. What was the term that you used again?
Tokenized.
Tokenized, right? Tokenized private equity, or almost, or like tokenized, not private equity, tokenized shares. So I'd be curious to see if that ends up being successful and if other companies end up doing that, because I mean, I've never heard of something like that before.
Yeah, it creates all kinds of interesting opportunities with being able to buy into whatever private company you want. I mean, you could sit here. I mean, like Chick-fil-A, for instance. What if we could do tokenized shares of Chick-fil-A? I'd be a buyer. There's all sorts of avenues.
Yeah, no, 100%. We got Beto here, not moving too much relative to where the overall market's been with Ethereum and Bitcoin, but I did get on a few new positions this week, especially after ripping to all-time highs. I wish I would have put on some of those positions today, but we got on some Netflix. It's been a little while since we traded Netflix, but I ended up selling an out-of-the-money call spread. It was pretty close to the money. The market ripping earlier on today, touching those, and now we're sitting in the money. But Netflix has been going on an absolute tear to the upside. Because I don't know if you have any thoughts on Netflix, but Netflix is not playing games. That's a sleeper build this year.
Yeah, absolutely a sleeper build, and something that I can remember being a magnificent stock just 5 short years ago that has since been replaced by other contemporaries in the market. But just continues to rip. Netflix is making all kinds of moves that I've been fond of. I think that their expansion into live sports and the things that they're trying to do with pay-per-view and boxing are very interesting, new forays for them, and I think that could be a very promising future moving forward, especially as they try to capture more market share in the NFL, which is something they've been pushing for. I believe they have the NFL Christmas Day games coming up again this year. I think that's the contract they have. But yeah, I think that Netflix, this traditional streaming service, which has really never wavered from that business model, like the way that Hulu has. Hulu moved into live TV some years ago. I think it's very wise of them to be making this move into live TV. They just keep on ripping. It's crazy, and it's insane to think that this mail order DVD company from 20 years ago is suddenly now going to become a major live sports provider.
I mean, we can learn so much from the run that Netflix has been having. I mean, I don't know what that would be in basketball terms, but I mean, Netflix is having, I'm not going to say a 97, 98 Jordan Bulls run, but I mean, Netflix, the way they've been adapting and pivoting over each decade has been phenomenal. I mean, we can only say that in hindsight as time goes on, but I mean, we grew up with Netflix. We grew up, going online, emailing or mailing those discs to your door. You go to the catalog online, you do that. And then also Netflix destroying Redbox. I thought Redbox was going to be the next thing. Redbox outside of all your grocery stores, convenience stores, very convenient, to be picking up and dropping off those movies. That was very short-lived. Netflix has stood the test of time. So, I mean, my initial thought was, man, how well are they going to be doing diving into live TV? Like, can they really, and given their history, given their track record, I'm not going to bet against Netflix here. Even though I'm still curious how they're going to maintain that industry for the live TV.
Absolutely. I think that they've shown, for decades now that their greatest strength is their ability to adapt. They've